Good morning. It is Friday, December 16th here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Brian Sazi. Julie Hyman has the day off. Brian, we've been keeping close tab on futures this morning as you've got the Dow futures down 1%, adding on to what we've already seen over the course of this week, and in a big decline coming off of some of that CPI data. Of course, we also had some commentary from the Fed this week, but it was really the economic data that rattled markets. We've got the Dow futures lower, Nasdaq and the S&P 500 futures lower.
Yeah, it's been a real ugly week for the markets, Brad, of course, triggered by, I think, a more hawkish than expected Federal Reserve meeting. I really like what Matt Milley said in his morning note over at Military Back. Really, the market is focusing on what the Federal Reserve has already done instead of what they might want to do. And what have they already done? Obviously, really increased interest rates a lot, and they're continuing to likely on that path. But the stats are starting to pile up this week. I think the past 2 days alone, Brad, we have lost about $1.1 trillion market cap in terms of the S&P 500. We see Apple down about 4% over the past 5 sessions, starting to underperform the S&P 500. It is getting ugly out there.
Yeah, we're taking a look at the Nasdaq 100 here right now, and this is yesterday's move, so don't get alarmed by what you're seeing there. This is not what we're seeing pre-market. I'll add on some of those numbers to what exactly is shaping up for today's trading session. But this is yesterday's move broadly here, and you really only have two bright spots. One of them was Align Technologies, Invisalign, great, and then Tesla with the descent as well in terms of where the broader markets were moving. But there you were talking about some of the mega cap tech stock moves that we saw yesterday too.
Nobody's smiling in that session.
No.
Even if you wear Invisalign, you're not smiling. Brad.
No, exactly.
Smiles.
I also want to point out one other thing, because we had some news out of China this morning too, and that really regarding what the economy there will look like in the near future. And we got that from state media, actually. State media coming out this morning and saying that the foundation for China's economic recovery is not solid. So just taking a look briefly here at some of the China stocks as well this morning. There we go. And as our board is pointing out, this morning at least, you are seeing actually some rises, but yesterday you did see some deep declines in the form of Alibaba, JD.com, and then Pinduoduo as well here. We'll see exactly where things settle out.
And that's why you're seeing, really, I would just add this quickly, Apple, top ticker on our site right now with good reason, really encompasses those concerns about China, but also recession. As recession fears rise in this country, can they go out there and buy that, $1,200 new iPhone? Probably not.
Yeah, well, Wall Street also buckling up for, get this, triple witching. That's happening today. $4 trillion in options set to expire. Let's bring in Yahoo Finance's Jared Blickery for the snapshot here, Jared. And I mean, of course, this makes what we're seeing within the markets even more perhaps volatile on the day too.
Yeah, well, here's the deal with triple witching. It used to be quadruple witching, no more, and that's because we don't have single stock futures anymore. We used to have options on those which would expire. So we have the futures, which are the E-mini, S&P 500, Nasdaq, and Dow futures, which are also expiring today, in addition to options. And all of this just means a bunch of risk, a bunch of bets that people put on in the market are expiring. So the index options that are bets, those are bets on the S&P 500, where the Dow is going to be, those expire on the open today. And then for individual stocks and the ETFs like SPY, that gets settled at the end of the day. So basically whatever the last tick is. Now, all of this options activity has affected stocks more and more over the last couple of years. We've seen the rise of the retail trader. Most options now are bought within 1 day of expiration, and there's a whole dynamic there that leads to. But the bottom line is option expiration is an important date. You get to certain levels in the S&P 500, those can become more important or less important. So we have a lot of what's called gamma that's rolling off today. But look, the S&P 500 has been in a holding pattern for the last few weeks. Now, the Dow happened to close at a 3-month low yesterday, but the S&P 500 is still in a trading range unless it breaks 3,900 to the downside or 4,200 to the upside. That's a range I'm looking at, still in that neutral pattern here. And despite all the weakness that we saw here from the week, as a result of that Fed announcement and also the rejection of what should have been a good news CPI report, I think all of this is pointing to the fact that traders are waking up to the potential for a nasty recession last year, and Powell has tried at length to convince traders and everybody else that that's going to happen, and I think the market just slowly realizes that on a day-to-day, week-to-week basis.
Jared, do you think volume will be higher than average the last week? Normally, Brian and I were talking about this before we came on. It's the holiday season. Traders are not necessarily at their desk, but if there is recession fears climbing and you have these wild swings in markets, do you think volume will be high and we might see more swings in the markets next couple days?
Yes, I think volume is going to be very high today, not only because of options expiration. I believe it's S&P 500 rebalance on the close. That just means if you want to take a bunch of big positions ahead of the new year, if you're a portfolio manager, you want to be seen with the right stocks in scare quotes at the end of the year, this is the last day to really get those positions in. So we might see some jostling here, but overall, we actually tend to see a little bit less volatility in the indices, although in individual stocks like Apple or Tesla, you might see a little bit of elevated volatility. It depends on the particular stock that we're talking about.
All right, hang on the desk here, Jared, here. As the markets react to the Fed's comments this week, our next guest warns not to expect a reversal of Fed hawkishness just yet. For more on this market action, let's bring in Charles Schwab, Senior Investment Research Manager, Kevin Gordon. Kevin, good to see you in person here. Just your take on what we have been seeing in the markets this week.
Well, I think it's a pretty clear, at least indication that we're probably moving away from inflation being the main concern for the market and stepping into, or at least bringing the labor market into the spotlight. Not saying inflation doesn't matter anymore, but I think, whether you want to look at the action, the reaction or lack thereof, I should say, relative to other CPI reports that we got on Tuesday, and then some of the comments from Powell on Wednesday, I think that we're probably, as we move into 23, at least inflation is going to start sharing the spotlight with the labor market. We still have a 7 handle on CPI, so it's not like it doesn't matter. But I think that given the emphasis now from Fed officials, most recently John Williams this morning from the New York Fed, on wage growth and how that's still one of the main causes that they see for inflation, I think we have to shift our focus to that, and investors have to too.
Within your notes as well, you talk about investors should be wishing for a recession sooner rather than later. What is the thesis behind that?
Well, I just think that if we're looking at it from the viewpoint of the Fed, and you want to see more economic ruptures, particularly in the labor market, I think to most everybody's surprise, the labor market's been relatively resilient this year and hasn't cracked maybe as much as certainly we would have expected. So you would almost wish for that sooner because it would signal to the Fed that their policies are working, not feeding through just to inflation, but also to labor. And obviously their forecast is for no recession, but implicit in their forecast is a recession if you look at the unemployment rate, especially with the latest increase from their summary of economic projections. But our theme has been, if you see that weakness earlier, it probably sets the market up at least for better days later next year. I don't want to base it off of, we get to June and then everything's fine, but you would almost wish for that pull forward because that's what they're going for. Effectively, a recession is a feature of what they're trying to do. It's not a bug.
Are people focused on the wrong recession, not the economic recession, but the earnings recession that might come next year? And how bad could that look?
I don't know if it's a focus on the wrong. I mean, I think it's, we're already in a form of recession. You want to view it as a rolling recession. It's happened in housing. It's happened in CEO confidence, consumer confidence, manufacturing sentiment. We think that the last legs to fall really are on the corporate earnings side and then ultimately the employment side. So I think we're right to shift focus to that. It's just going to happen in different pockets. The earnings recession is happening for goods-oriented companies and those that benefited most from inflation and that surge that we got. It hasn't happened yet for services-oriented companies. We think that'll probably, it'll start to shift into there, not anything catastrophic like you saw in 2008 or 2020. But it's probably going to start moving its way there if that's what ultimately the Fed wants to see.
Just a follow-up to what you were mentioning earlier. What's the risk if we don't see a recession sooner rather than later? What is that kind of longer drag effect that we have?
Well, it depends why. I mean, if it's because wage growth is sticky and it's taking longer for that to come down, you still have companies hoarding labor, then I think that risks a worse recession in the future. I mean, I think that would be worse for risk assets because, it would at least, if we get a little bit of a lift, if you see a little bit of a reprieve because there is a notion of a soft landing unfolding, that's probably good in the near term for at least the stock market and what we cover. But I think it ends up being worse in the long term because that either means that the Fed has to keep the terminal rate at its elevated, or the Fed funds rate at its terminal rate for longer and or maybe go a little bit higher if they're not satisfied where things are going. So I do think if you push the recession out further, it's probably worse because I think that the labor market strength in a way is probably its biggest risk and its biggest weakness later on.
What move should the average investor be making in this environment into year end?
Well, year end is I guess 10 days, so it's always tough to do that a couple of weeks. But moving into next year, we're still sticking with high quality earnings themes around profit margins, but specifically looking for pricing power now because one of the themes that you had seen in 2021 into 22 was companies that benefited a lot from that inflation surge. Top line and EPS growth was great, but now you're starting to see more of a divergence. And companies that can maintain that pricing power will probably continue to do well, especially because input costs are still high. You haven't seen a release of labor, so unit labor costs have taken longer to come down. So as long as you can find that right mix of companies, and it's across the cap spectrum, it's not just large cap, it's not just small cap, we really think that you can look across sectors, across cap, and across many factors and just find something that's high quality, specifically as it's relating to earnings.
And so further out then, if you were to just find someone's recession portfolio and what that encompasses, is it more defensive? Does that continue to hold staples? How should people be repositioning?
It's not necessarily, I actually think staples, utilities, some of the traditional defensive sectors we think about, a lot of those companies have weak earnings profiles because they were the ones that benefited from inflation and from that strong top line growth, but now they're not able to benefit from that, even on the downside. So they're not able to be those standard recession plays that you see. So that's why we've taken much more of a factor-based approach, looking for things with strong earnings yields, strong cash on the balance sheet, able to withstand any pressure from the dollar, both to the upside and the downside. It's a narrow group now because you have so many of these forces working against you, but as long as you're able to take a factor-based approach, not just look at sectors, especially something like just staples or just tech, because within that you have so many divergences in performances throughout this past year as to what's been doing well, but what's also not been doing well. So you have a mix of growth and value factors that have been giving you different signals. So that's why if you just focus on the factor, you don't need to necessarily be worried about the sector.
Charles Schwab, Senior Investment Research Manager. Kevin Gordon, always a pleasure to get some of your insights. Happy holidays to you.
Happy holidays, thanks.
You guys, coming up, Twitter cracking down on journalists. We've got the latest there. It's next. More turmoil at Twitter. Journalists covering Twitter's ban of an account that tracked Elon Musk's private plane, they found themselves banned from Twitter without notice. Twitter owner Elon Musk saying the accounts were suspended for doxing, despite the journalists saying that their tweets contained no information. Joining us with more, we've got Yahoo Finance's Dan Howley. Dan, just break this one down for us and what the latest is in the craziness out of Twitter.
Yeah, well, so much for free speech on Elon Musk's Twitter, eh? This basically happened where a few journalists from different outlets, New York Times, Washington Post, had been reporting on the Elon Jet Twitter account, which Elon had suspended from the service. The Elon Jet Twitter account had posted tracking information about Elon's private jet as it was flying, where it was going, things along those lines. And they were reporting on the fact that it was suspended and that it was kind of counterintuitive to what Musk had said, where, he wanted full free speech and that anything that was illegal would be taken down and anything that was spammy or bots would be taken down as well. So, this isn't that kind of account. The reporters then were suspended, he said, for doxing, which, by the way, this is not doxing. This information is publicly available, flight tracking information that people use. Airline enthusiasts, people like that use this kind of information all the time. Doxing is when, if you're a person, someone is trying to get back at you or something along those lines. They post your address, they post where you work, they may post private photos of you, things along those lines. Elon Musk is the second richest person on the planet. He's not exactly a private citizen either, so this isn't really doxing, and it's worth noting that this wasn't data on where he was, despite what he says. This is where his jet was. So his jet flies sometimes without him, not necessarily him on board. Regardless, he went on to then suspend those reporters and then joined a Twitter Spaces last night where there was a conversation among some of those reporters and their colleagues, again saying that he was going to suspend them and that it was doxing. And then when there was pushback on that, he quickly quit the chat and then disabled Twitter Spaces to what he said was fix a long-standing bug. So these reporters are suspended for 7 days. There's really been no other comment outside of Elon posting some polls on when he should reinstate them. The first poll was asking if they should be banned for longer or restated now or be suspended for 7 days. It came back that people said they should be reinstated now. He then has a second poll going saying that they should be banned or be reinstated now. And again, people are saying that they should be reinstated now. So, I don't necessarily know what that means for Elon and his popularity on the platform that he bought, but this clearly is kind of blowing up in his face, especially after he said that he was going to do all of this in the name of free speech.
But Dan, it also can't help his cause to bring back advertisers on the platform, right?
Yeah, I mean, look, this is just a complete black eye, and it seems like he's, the whole thing was advertisers were nervous that he was going to allow unfettered free speech. He said he wasn't going to do that, and then he reinstated a bunch of accounts that were banned for, posting terrible content. Advertisers were clearly bothered by that. They had been pulling back, the idea being that they don't want their products, tweets about their products showing up next to some white nationalist, right? So they were nervous about that. He had kind of this rant about Apple and Amazon, or Apple rather. Met with Tim Cook. Apparently, Apple is now advertising there again. Amazon is apparently advertising there again. But there's a bunch of others that still may or may not be back. There's no real clarity on that quite yet. But if you're an advertiser and you were hoping for some kind of stability at this place after this whole rigmarole of him wanting to buy it, not wanting to buy it, then buying it, and then the whole free speech aspect of it, this does not help at all. You're right. This kind of just throws everything up in the air again, because there's no clarity as to if there's a clear set of rules. He said that he was going to wait for a moderation council at one point to make any kind of content decisions, and he clearly hasn't done that. Having this kind of blanket amnesty for folks to come back on the platform, then banning people like Elon Jet after specifically saying he wasn't, because he was part of, he was hoping for more free speech. So, this is all kind of seemingly by the seat of his pants. And if you're an advertiser, as I said, looking for stability, this is far from it.
Yeah, Dan, I mean, of course, for even the ad campaigns that have come back, there's a question of how much of that is just seasonal. And once you get through the holiday season, some of those promotions and the campaigns to really move through some inventory, once they subside, then what? Will Twitter still be making money? That's perhaps a whole separate advertising conversation. But I think one thing that you started to get to at the end there was just what's the end game for Elon, for Twitter, and where it could even continue to or grow from here?
Yeah, I mean, look, he's pushing the Twitter Blue service. That's available now. You can get a check mark after a waiting period of launching your account. You do get the ability to edit tweets. So that's out there. He also, obviously still is generating revenue through advertising, though he wants to move away from that. It seems as though this is kind of like he wants it to be almost his little clubhouse where he only lets people on to talk to each other that he agrees with. And if they seem to run afoul of him, they'll be banned under some kind of, weird definition of what he thinks is violating the terms of service. It's worth pointing out that the guy owns the platform, right? So I guess he can do what he wants when he wants because it's his platform. But for him to come in and say that this was a free speech issue and he wanted as much speech on there as possible, I mean, this is just hypocrisy. And I think as far as how the platform continues forward, perhaps he needs to take a step back, let someone else kind of call the shots there rather than him. Maybe focus on Tesla. Obviously, people are shareholders of Tesla can't be happy about this. SpaceX is obviously a major concern for national security. Maybe he needs to focus more on that. And the FTC is looking at him to ask if how Twitter will continue to abide by that consent decree regarding consumer privacy. So there's a lot going on here, and it seems as though there's these issues that he's kind of jumping onto that he doesn't necessarily need to.
So very true. All right, Yahoo Finance tech editor Dan Haley, thanks so much. Straight ahead, a slow Friday. This is not. We'll take a look at earnings out of Adobe and a few other hot Yahoo Finance tickers next. We're still a few minutes away from the opening bell, the final one of this very tough week after that hawkish Fed meeting. But before we get into that, let's dive into some trending tickers that are moving here this morning. Shares of Adobe in focus following an earnings beat on the bottom line, while revenue came in line with street estimates and increased 10% year over year. This is the top ticker on our website right now, up about 5% in the pre-market. And Brad, some holes to poke in here, and Brent Thill over at Jefferies poking those holes, noting that a key metric, the performance obligations, that growth rate slowed in the quarter. He's also calling out some potential risk to their fiscal 2023 guidance. In his view, does not embed enough economic risk. Thill says a recession could lead to layoffs and fewer Adobe users. That might not be priced into the stock here.
Let's talk about some of the numbers within that guidance. The targets for fiscal year 2023, and they just wrapped fiscal year 2022. The total revenue target for fiscal year 2023 is $19.1 billion, upwards to $19.3 billion. They're also trying to get a digital media net new run rate, basically, of about $1.65 billion there. But all of this considered, you're really looking across three segments here. It's digital media, it's digital experience, and the subscription revenue within that digital experience too is going to be key. And that subscription revenue they're anticipating is going to come in at about $4.375 billion and, upwards of $4.425 billion. But anyway, at the end of the day, it's really just going to come down to, again, how many of those customers they can retain and then add on. Because if there's one cost restructuring measure that some companies do take, is they look across the number of licenses that they do have for some of these services. And as a former marketer, I remember using some of the Adobe services and the different acquisitions that they made over time to really integrate more licenses and more components into this overall umbrella of services there, and their suite of services. And so if you do see corporations saying, we don't really need this many licenses for this type of service, then that could be one of those headwinds that they're talking about.
So they don't just make PDFs?
They don't just make PDFs.
No, of course I do that, of course. No, and I'm glad you mentioned acquisitions, because this is a company that is still trying to close on this acquisition of Figma. A huge, really one of their largest acquisitions in their history. That is that process of closing that deal at some point when it does later next year, that process, getting to that point of closing the deal, also seen as a major risk to the stock here.
And investors didn't like that deal when it was announced. The stock was sent lower immediately on the reaction to them announcing the acquisition of Figma, or the intent to acquire Figma. And it's really just a question of, in this environment, how many investors are going to actually reward some of the capital that's going out the door for this a kind of acquire to growth strategy that a lot of ERP or even cloud-based services have really grown accustomed to over the years. And it's going to be heavily scrutinized. People and investors and shareholders especially are going to say, well, why are you spending this money when you could be hunkering down some of that cash for a rainy day? And it's pouring right now.
So no more PDFs. No, but this is why I like this season for analyst notes. I like Brent's title. No big surprises under this tree. And even Brent's not alone. You're seeing a lot of catchy headlines out there on these analyst notes. It is Santa season and holiday season. I like the creativity.
His note, a PDF.
Yes, it's true.
Also,
it actually is. I just downloaded it.
Shares of Faraday Future Intelligent Electric. You haven't heard about this one a ton, but we're going to talk about it this morning because it's in focus. It's getting hit hard after the company announced that they would acquire an additional $150 to $175 million from new and existing investors in order to start building its first electric SUVs by the end of March. The CEO saying the company has letters of intent for a significant portion of the financing. The shares are down like more than 90%.
37-cent stock. They've made nothing, Brad. I went to go refamiliarize myself with what their first car is supposed to be, their EV, at some point next year when that comes out. I believe it's April. I just saw a Reuters story cross a little while ago. It looks like an Apple mouse with some tires on it. There it is. Actually, you can see it right there. Tell me that does not look like an Apple mouse.
It does look like it looks like an Apple mouse.
Apple mouse.
A lot of the EVs are starting to run a little similar to each other in design, at least. But
it's really boring. Oh wait, Brad, I just fell asleep while looking at that thing.
I honestly do not know a ton about this company's cars, the vehicles that it intends to put on the market.
It plugs in the back. That's kind of cool, though.
Well, yeah, but that's also gonna. I don't know. It's gonna be interesting when people go to try and charge it.
But just the fact the stock is trading at 37 cents, it's another just indication that here's an electric vehicle that maybe doesn't make it.
Yeah.
Just because you come out with a flashy concept car and you are in that electric market doesn't mean you will have success. Not everybody is going to be the next Tesla.
All right, 48 cent stock. That's enough we're talking about it for today. Well, let's tee up the market activity that we are trending towards here. As of right now, we're seeing the Dow futures down by about 1%, just about 20 seconds until the start of trade. S&P 500 futures down by about 0.9%, and the Nasdaq futures tech-heavy average that got rocked yesterday, down 0.3%. Let's see how things open up.
And there we have that opening bell on Wall Street, which, we can see another tough session here. Brad, the past 2 days, not too good. The S&P 500 has wiped away about $1.1 trillion in market value after that Fed meeting. Really drove up the concerns about a recession in this country early next year. At the same time, the Fed is still out there raising interest rates. Right now, we're seeing the Dow open down about 223 points in what could be another volatile session, Brad.
All right, well, maybe Harry can do something about it. Dow Jones Industrial Average, as of right now, you're seeing that open lower by about 0.6% here. And let's take a look at the chart over the course of this week, because we've had economic data, we've had, of course, the Fed decision and the final Fed decision of 2022 in what has been a heavy interest rate hiking period for the Fed and is set to continue going into 2023, at least for what the Fed has signaled thus far. Markets continuing to digest that. But again, here we've got the Dow once again not impressed and continuing to move lower. It's down by about 0.7% here. Nasdaq Composite, you're seeing that lower by about 0.4% this morning. Past 5 days, net lower by about 2.2%. And the S&P 500, you're seeing that down by about 1.6%. Now, here's what's interesting, and Sazi and I were talking about this before the show began, is that over these next few weeks, you're going to see lower trading volume, because that's typically when some of the traders take that holiday vacation. So some of that low volume may lead to some of those outsized swings as well. So keep a close eye on that, and that's the context there. And then lastly, we'll take a quick look at some of the sector activity. Looks like we only have one positive sector right now. That is communication services, up by about 0.25%. Everything else in the red, Saz.
Indeed. All right. We're also watching shares of Darden Restaurants, ticker symbol DRI. Those shares are getting hit about 6% here in the early going, following an earnings beat for the second fiscal quarter, as the company exceeded expectations on both the top and bottom lines, as well as raising its full year 2023 sales outlook. Brad, I think while you're seeing the sales, the stock come under pressure here, this is historically a stock that usually gets driven by its largest business segment, and that is Olive Garden. And it had good same-store sales, but if you go down to the bottom of their earnings release, operating profits for Olive Garden down about $15 million year over year. At the same time, sales were up. Of course, restaurants dealing with still high levels of inflation for food and workers. So market unlikely liking that call out. But I will say this, probably one of the best deals in sit-down restaurants right now, Brad, is if you go to the Olive Garden website, you can get 16 shrimp as an add-on for your pasta for $5.29. That's 33 cents a shrimp. To me, that's pretty good. And it's shrimp.
Do you think that's the freshest shrimp that you can get on the market?
The website suggests it is.
You think it's good for you?
I'm a believer on the website, and I'm a believer in Olive Garden.
Okay. Well, it's a deal. That if there's anything we can classify it as, it is a deal.
That's
and
16 shrimp, Brad.
Well, it's
33 cents each.
You know what? Perhaps it's a pre-recessionary hedge for a lot of households.
And you look, the other options you get on the site, you can get 3 meatballs for about $5. I'm going for the shrimp, 16 shrimp.
As long as they still have the unlimited salad and breadsticks, I think that is key, and that is perhaps baked into my financial planning in the future too. Also, looking at some of the other segment performance that we've been tracking, it's interesting also to take a look at Longhorn Steakhouse, particularly for me sometimes, because
good food.
Good food, yes. But some of the growth that we see year over year with Longhorn Steakhouse and the profit that they're continuing to bring in, this is one of the biggest, or the second largest area for them in terms of their Q2 segment profit. So Longhorn Steakhouse, don't sleep on them, the quality there.
Don't sleep. I can't get into the one by me on the weekend. It's by a movie theater. I know it's crowded. It's crowded. I'm trying to pull up the menu here on these steaks, but I don't think I'm going to get to it in time. But still, Longhorn Steakhouse, very, very good.
Well, you like to cook your own steak on your Traeger grill anyway.
My Traeger grill, yeah, right. My one-bedroom co-op. All right, let's go from meat to tech. Shares of Meta in focus following an upgrade from JP Morgan, as they now rate the stock at overweight, up from neutral, as well as raise their price target on the tech giant, I believe, to $150. I have the full story on this now on the Yahoo Finance homepage. But Brad, a rare upgrade on Meta, a stock that has been hammered by about 60% year to date, and you have an analyst coming in here saying, you know what, maybe the bottom is in, and one of their reasons why they think now might be the time to buy. It's just valuation, because of that 60% drop, perhaps just maybe too cheap.
It's been hammered for good reason.
Yes.
They're spending on
because they're not selling shrimp, Brad. They're not selling shrimp. They should be selling shrimp.
Right. And what is the future of shrimp sales in the metaverse? Because that's what they're spending on right now. And for the amount of cash that continues to go out the door with Meta, and investors continuing to kind of hold their hand over their face and just kind of look through the fingers to see, okay, when are they going to be done just bleeding cash to try and make the metaverse happen, like Gretchen trying to make Fetch happen? I think at the end of the day, it's still going to be a question of how many people are actually interested in purchasing the devices. There's so many immersion devices that are necessary for the metaverse to actually be a thing. And if Facebook does not own that device, that is another headwind for the costs, because they're going to continue to try and spend to make one of either the virtual reality headsets or some other device that they try to put into the home, the immersion point, or at least the entry point into that metaverse. And I don't think people are buying it.
It's a bold call. Some analysts, I was there. Sometimes we try. I tried to be a hero at some points during slow periods in the market. I would try to put on an upgrade just to drive a little excitement, get a little notoriety. A lot of times it worked, and maybe that's what they're doing here.
All right, well, here's the ad. Goldman Sachs, everyone, switching gears. Before we go to break, we want to bring you some news that just hit. Goldman Sachs is planning to cut 8% of its workforce. This is according to reports. Now, this planned move, it comes as the bank braces for a tougher environment in the new year. The planning is reportedly ongoing and could be smaller than 8% and will likely happen in January ahead of its next investor conference. Coming up on the other side, Yahoo Finance's Rick Newman is going to break down the Fed in this week's Bidenomics. We go into the Newmaverse next. The Federal Reserve rocked markets this week after signaling it would continue hiking rates until and through 2023. The unrelenting pace of rate hikes and the state of inflation in the U.S. is where we find Yahoo Finance's Rick Newman with this week's Bidenomics. Rick?
Hey, guys. Do you remember when Donald Trump used to bash the crap out of the Fed when it it raised rates like a quarter of a point or a half a point, and it did that for only a couple of months. Well, President Biden must be feeling that way because things were looking really good on Tuesday when we got that inflation report. It fell by more than expected, and there are other signs that it's going to keep falling. And then the Fed came out and said, nah, we're not impressed. Everybody knew they were going to hike by half a point, which they did. But then Powell, the chairman, he basically said, we're just going to keep at it. And, the market after that just interpreted the Fed as saying, we're just going to drive this economy into the ground if that's what it takes to get inflation under control. So, we're beleaguered with a grumpy Fed right now, which is why we're selling this big sell-off in markets. I mean, markets loved the inflation news on Tuesday because they thought the Fed might be able to ease up a little bit. But the Fed came in hot and said, nope, we're not easing up. So, this increases the likelihood that we will get into a recession in 23 and that it might end up being worse, maybe a moderate recession instead of a mild one. So President Biden is not saying anything about this, but he's got to be feeling that the Fed might be overdoing it a little bit.
Rick, you're on fire today, so you're going to get another question from me. I think you're also watching that government spending bill.
Yeah, so there's now this temporary spending bill that looks like it's going to pass. It's just going to cover spending for a week. But that's good news because it does look like there's agreement that there will be a longer-term spending bill that Congress is going to pass before it leaves for Christmas break. Now, anything could still go wrong, but the interesting battle here is some Republicans don't want a long-term spending bill. They want a short-term bill because they will take over the House in January, and they think that if they can push off spending decisions into next year, well, then the Republicans will get a much bigger say. But there are some other Republicans, including Mitch McConnell in the Senate, who say, no, let's just get the most of the spending covered for 2023. Then we can talk about other Republican priorities next year. So it does look like we probably will get a longer term spending deal next year, which just means it's not a government shutdown is not something we're going to have to worry about. Let's hope it goes that way.
Rick, you saw our last segment. I hear you're a Red Lobster guy too, right?
You guys got me talking about Olive Garden. You guys got me really thinking about Red Lobster, which was my first job, real job in high school. I was a dishwasher at Red Lobster. And when you see one of those restaurants from the inside, you think about it a little differently, Saz. I'll just leave it at that. When you start talking about cheap shrimp, I think about that uneaten shrimp coming through the conveyor belt into the dishwasher shack at Red Lobster. It's a little different from the image you have of the gleaming shrimp on the Olive Garden website.
Rick, can we still be bullish on the Cheddar Bay biscuits, though?
Sure.
Okay,
go for
great.
the biscuits.
Rick, you're a true American.
It's that seafood that makes me queasy.
Rick, you're a true American success story. You should send your story into the administration. Rick Newman, always good to see you. We'll talk to you soon.
I got it.
Tesla is down 61% from its peak last November. Now the largest drawdown dating back to 2010. You can see in the chart right there some of the biggest drawdowns or sell-offs in Tesla's history. Go back prior to this recent drawdown or sell-off, the largest decline actually came from February 19th, 2020 to March 18th, 2020, about almost a 60.6% decline. These fun data points come compliments of the folks over at the Compound. Coming up, we'll get a top pick for 2023 from the industrial sector. Do stick around. Caterpillar is being called out as a top pick for 2023 by the team over at Cowen. Let's go inside the call with Cowen analyst Matt Elcott. Matt, good to see you here. Make your case on Caterpillar, because I think some would argue this is a contrarian call to make a play on an industrial machinery company if we are going into a global recession.
Yes, Brian. It may be. Actually, this is the second time we pick it as our top pick. We had it as our top pick for 2022, and it's for 2023 as well. It is a cyclical company, and it would appear to be a contrarian call when you're looking into a recession. But I think this cycle has many nuances to it. First of all, you have the infrastructure bill. The narrative coming from the machinery companies over the last few quarters has been that projects related to the infrastructure bill would start hitting the backlog late in 2022 and into 2023. The last concrete data point we got on this was from Deere, which has an irregular fiscal year and reported in late November. And they've actually started to see that. We're looking at the shipments of sand, crushed stone and gravel on rail, which we identified back when we initiated last year as having a 0.9 correlation with CAT's North American construction industries business. That's been the highest performing car loading group on rail, up about 12% versus rail traffic being down 1%. That's been like a consistent story for the last year or so. So those are, the infrastructure dynamic is not really a cyclical dynamic. It's just it's an anomalous event that will continue to benefit CAT for and Deere and many of the other construction equipment companies for the next few years. And then the other thing is what I like to call the global state of energy insecurity post the Europe conflict, where now we're scrambling to get our hands on any type of energy we can get, whether it's conventional or new power technologies. And that's going to be a big tailwind for CAT's mining segment and oil and gas segment, but primarily the mining segment, because we've had false starts to the mining equipment replacement cycle for about 10 years or so now, because the miners have been under pressure by shareholders to do share repurchases instead of spending money on projects. So I think that's going to take off finally. So you're right, it's a cyclical industry in a slowing economy, but there are many dynamics that are unique to this cycle, which will extend it to 2024.
Matt, that started to get into what my question was on the global front, because if we were to see a slowdown as some of the other countries around the world perhaps enter into a recession prior to the U.S., what is that exposure that Caterpillar has if those countries do start to pull back on those construction projects that they had either earmarked funds for or just holding off on beginning?
Yeah, no, that's another great question, Brad. I mean, it's all another nuanced picture, because you're probably going to have certain regions of the world pulling back and becoming more tempered, like Europe, and then you're going to have at the same time regions like China hopefully starting to rebound. Remember, China was the first to do lockdowns back in late 2019, early 2020, and when they did reopen the economy, they had basically one of the biggest ramp ups in their history as far as manufacturing. We're not expecting anything like that now as they ease COVID restrictions, but you could see China start to improve in 2023 and into 2024 as Europe, tempers a little bit. India is probably going to continue to be solid because there is an infrastructure bill there. There's a lot of infrastructure spending. So I think on the balance, when we look at the rest of the world, it might be net neutral for CAT in 2023. But I think the North American picture is going to be more positive.
Matt, one risk that you call out that I don't hear a lot of your peers calling it out, at least when it pertains to Caterpillar and other companies like it, is someone on the street view it as an unfavorable play on sustainability. Walk us through that.
Yes, they have pretty sizable exposure to the mining sector. They sell equipment to the oil and gas sector, so I think those are the two main things. So before the state of energy insecurity we entered after the Europe conflict, people viewed a good portion of their business as being in secular decline. When I did my analysis when I launched last year, I put that percentage at 28%, because you can't really punish them for the part of coal that's metallurgical. You need that to, if you're going to have any type of growing in a global industrial economy, you need metallurgical coal, even for EV growth. So thermal coal will be in secular decline, but I think 28% was the percentage that I came up with as having less than favorable, ESG attributes. I think some people's calculations probably included a slightly higher number, maybe as much as 1/3 of the business or just slightly more. But I feel like investors now are more willing to exercise patience in this new world we're in.
You mentioned John Deere earlier. Is what you're believing to be true for Cat not true for John Deere?
It is true for John Deere, Brad, but their exposure to the construction industry is lower than it's sizable, but it's lower than Cat's. John Deere has been really a precision ag story for years now. It's a theme that a lot of investors are very bullish on, rightly so. It's it's a very promising area. I've been a little bit more cautious on the Deere stock than I really needed to be. We have it at market perform, but the stock has really done very well over the past year or so. But I don't think the prospects of 2024 being another growth year for Deere are as strong as they are for Cat, because they don't have the mining exposure, they don't have the oil and gas exposure, and they have a smaller exposure to infrastructure.
Matt, before we let you go, you also highlight a 10-year, $30 billion sales opportunity for Caterpillar from autonomous various operations or ventures they may be going into. What does that look like for Caterpillar? More machines that don't require a driver?
Yeah, more machines that don't require drivers, mostly initially in closed environments like mining. They already have autonomous trucks there that improve efficiency and productivity. Actually, this is a very timely question, Brian, because I think just yesterday or the day before, they announced the first autonomous partnership with an aggregates company, a crushed stone and sand and gravel company. So they're introducing autonomy into that market as well. I think, what's next is probably, longer term is road building and construction, introducing autonomy in a kind of phased out manner. That's it. It can be a closed environment, but it's more open than mining or aggregates. So, there are opportunities across their many businesses to grow revenue there.
Cowen Transportation OEM's analyst, Matt Elcott. Matt, really fascinating stuff there. Thanks for breaking this down for us. And everyone, coming up on the other side of this short break, the stock investors love and love to hate ahead of earnings season. Sazi's going to share his take next. It's almost 2023, which can mean a lot of things. But to Brian Sazi, it means earnings season is less than a month away. Start your countdowns, folks. Sazi, your take today, you're looking at some of the stocks people love to hate.
Yeah, for normal people, they're looking for time with their families. I'm already looking to 3 months from now. We're in the smack in the middle of earnings season. No surprise there. All right, so let's start off with this. There's a lot of optimism coming into this earnings season that we will get very, very soon. Really, the starts in the second week of January. And you can see that chart on the screen right now. You can see that earnings optimism is starting to fade and fade pretty aggressively, I think as a result of fears about a recession. Interestingly, according to FactSet data, 55.3% of stocks in the S&P 500 are rated buy ratings. Only 6% or so are rated sell ratings. So the street is very I would say optimistic on stocks going into this earnings season. Next up here, you can see where a lot of the optimism lies by sector. Analysts are the most optimistic on energy at about 63%. They are the most pessimistic on consumer staples, which is interesting because companies like Campbell Soup have recently reported some very good earnings as a result of pricing power. So maybe an opportunity in those companies that nobody is sniffing out here. Next here, we're looking at some of the companies that analysts have the most buys and sell ratings on here. Let's throw them up on the screen. Some of the most popular stocks there you can see on the screen. The most popular stock is a smaller company called Bio-Rad. You have Jacobs up there as well. And then further down the list on these top buy-rated stocks is a company that you know and I know well, pretty well, Brad, that is ServiceNow, run by Bill McDermott from the show. And then another one, Alaska Airlines, also viewed as a very good pick here. A couple stocks that analysts do not like here or have sell ratings on these companies. Let's run through this. T. Rowe Price. We have Con Ed. Clorox company, we've been very critical here on Yahoo Finance after pretty much, I would say, 5 quarters in a row of just very bad results. James Smucker, surprised to see them on this list here, but certainly falls with the street being a little more cautious on consumer staples names going into next year. And then, lastly, just looking at some of the other aspects to this call by FactSet, it's just a lot of analysts, I think, are just entering the season very, very optimistic. Maybe they should fine-tune their estimates a bit.
The big question, too, is, and I would love to get your take first, and then we can talk a little bit more about it.
Take is this. Buy holds and sell ratings, they may not mean much. There we go. There we go. A buy-rated stock doesn't mean buy, and a sell-rated stock doesn't mean sell. You could very easily, we can be having this conversation from 3 months from now, Brad, and a company that is rated sell or by a majority of analysts on the street, they have a comeback quarter and the stock goes up, and vice versa for buy-rated stocks.
And that's actually what I wanted to get at, was because could this finally be the earnings season where if we have enough talk going into it about the repricing of some of the earnings estimates and then the actuality of that being reported by the companies, could we finally see a season where investors can look to the results and then look out into the future and say, you know what, a recession now at this point might be priced in to these shares?
I see where you're going. I hear that point. No, it's
tough to call.
No, you're on the mark, and it is tough to call, Brad, because as we just mentioned, only 6% of the companies in the S&P 500 are rated sell. Mm-hmm. So I still think this is an analyst community. At least those companies that track these S&P 500 companies and put out their models on them. They're always hopeful. They're always looking for great things. And look at what we've seen in tech. These stocks have been absolutely slaughtered this year, and yet most analysts have stable buy ratings on big cap tech names.
Absolutely. All right, well, we'll keep a close eye on those companies going into the start of next year and the next earnings season. But coming up, we've got a sweet conversation with the CEO of Krispy Kreme on the back of its Investor Day. Yes, that was a roll bounce reference on the sweetness.
Welcome back to Yahoo Finance. I'm Brian Sozzi alongside Brad Smith. Julie Hyman has the day off. Markets, well, they're under pressure for the third straight session. As global central banks have spooked the bulls. Right now, you're seeing all three major indices in the red. The Dow down about 240 points here. Of course, the S&P 500 also, well, in the red. Now, here's what's on tap this hour. No house, lots of crypto. A Wall Street veteran stops by to share his hot take on why housing caused the Bitcoin bubble. Yes, for real. All right, another big reveal. We'll get an analysis on another hot Yahoo Finance ticker from 2022 from our very own Jared Blickery. And chew on this. Krispy Kreme CEO Mike Tattersfield stops by after shares were hammered Thursday following a key investor day. Brad, over to you. I see we have some donuts on the desk. I can't wait to just dive into them.
Yeah, we're going to do a quick market check so we can get to that sweet donut craving that we have here. The Dow Jones Industrial Average, as of right now, you're seeing that down by about 0.75%, 0.7% here, just about 34 minutes into the start of trade. Over the past 5 days, net lower as well there, as well as the Nasdaq Composite. You're seeing that down about 2% over the course of the past 5 days, down 0.4% here today. And S&P 500, you're seeing that down 0.8%. Do want to take a look at that Nasdaq 100 and the components therein, and take a glance at some of the mega cap tech stocks. As of right now, we've got Apple down by about 0.4%. Same case there for Microsoft on a percentage basis. Google or Alphabet, you're seeing that down about 0.2%. However, interesting performance on the day. Meta, that's higher by about 5%, nearly 6%, and that really coming off of one of the analyst calls that we were talking about earlier. And so we'll continue to see where that moves the stock. Adobe, we were talking about those earnings results. Adobe shares are up by about 6.2% here on the day. And then just lastly, let's ride out with a quick look at some of the sector activity here. Only got one positive mover on the 11 S&P 500 sectors right now. That's communication services, real estate, bringing up the caboose. As of right now, you're seeing that down by about 2.8%. And then one of the other largest laggards right now on the day, energy. Interesting. Down 1.8%.
Right, hurry back here, Brad. We got donuts on the desk. All right, shares of Krispy Kreme, they're in focus after investors took a bite out of shares yesterday with the donut chain announcing guidance that wasn't as sweet as the street expected. We're joined by Krispy Kreme CEO Mike Tattersfield alongside our very own Brooke DePalma. Good morning to you both. Mike, I'll start with you. Really a very in-depth presentation by you and your management team. Is there something that maybe you didn't get across to Wall Street?
No, we spent time talking about our U.S. transformation and all the things that we need to do to drive the business forward, showed the growth story, even up to 75,000 points of access, and both the U.S. and international, and even gave the first glimpse of what's going on with Insomnia Cookies, which is one of the brands that's under our guidance, and we own about 70% of that brand, and it's showed its TAM of 4,000 cookie shops, 1,000 in the U.S., performing incredibly well. Gets basically a year payback on a cookie bakery, right? So again, very bullish. We even tell them how we reiterate our guidance, which is going to be a 12% organic revenue, and then if you even take it in constant currency at 7% this year in EBITDA, you lay out what you're trying to do in 26, it's within the same algorithm that we've had. So I'm focused on driving the business. This is where I spend a lot of my time. It's a great business.
Well, Mike, it took about 1 minute for Brian and Brad to dive into the donuts. So while they're chowing down, I'm going to ask you a question here. But Wall Street keeping an eye this morning on longer term automation. They're certainly saying, can we expect to see robots in the next year to increase productivity in terms of icing, filling, boxing? So to break it down for us, will we see robots in locations, in the back end, in the next few years?
So probably within the next 18 months, you'll see some automation starting to go into the frosting, the filling, the sprinkles, and even the packaging. We've got some pretty big factory stores. Again, if we do 12,000 points of access today, which get fresh donuts globally, you need to start looking at what the automation capacity of that is, because it is going to the grocers, it is going to the convenience shops. So you'll start seeing that start to happen next year, and you'll continue to see a little bit. We still are going to continue to drive, the experience side with our Krispy Kremers and Insomniacs. So, I always find that when companies do a great job, they're balanced in how they try to do that. And you try to get the repetitive task out of the business.
Mike, talk to us about this global expansion here, because that was one of the major items that you were pointing out to investors, and particularly what that looks like over the next 5 years here. What is the key country that you see as the biggest opportunity for Krispy Kreme to move into?
So it's pretty interesting. We spent a lot of time over the last 4+ years, really getting this transformation to a hub and spoke model, right? A hub being those theater shops that that make the donuts, but then it's really the back end where a logistics system takes them to the grocers and other place where consumers are. When you have a model like that in international, instead of, it's a donut company versus a franchising business, a partner comes in and can build 4 of these theater shops and then potentially build between 500 or even more than that points of access to the grocer points. That's very attractive to partners. We've had no problem signing up the right partners in the right countries. So you heard about our venture with France. We're looking forward to seeing how that will come about in the next 5 years. So you're getting to that 500 points of access with the right balancing of theater shops. We will open up between 10 and 25 what I call theater hub shops on a yearly basis between equity and partner doing that. But you'll see that the 80% of the business will start to be in new unit development, will be in franchise, in the international part of the world. The growth is significant. You'll see Western Europe, you'll see South America, right? And you'll see continued development in even the 30 countries that we're in today outside the United States. It is the largest part of our business is international. And there's still tremendous growth opportunity in the United States as we really think about a hub and spoke model.
And when you think about that consumer here in the U.S., pricing is certainly top of mind as we make way into 2023. Of course, you have classic, you have premium, you have those handmade donuts. When you think about the pricing of those more premium donuts, are you noticing consumers still going to those? And can we expect pricing across the board to take again in 2023?
So again, we do. We're a dozens business, right? So even when we always try to focus on how do you do the affordable sweet treat reach. So that's always on our mind as we go around the world. That's why you have that range from the original glaze up to, hand cut donuts. But, you can get to a pricing model in the original glaze that you're pretty close to $1 per donut, which is very still reasonable, that it's freshly made, right, every single day. Even if you go to the premium side of that, we're talking about $2.50. So it's not that far out of reach. We have not, in fact, we see more people trying to try that premiumization because they're exceptional. All of our donuts are, but they're pretty unique when we try to go after some of these things. The company thrives on innovation, so we continue to make sure that that's at the forefront and everything, even our own challenges, make sure it's worth it.
Mike, how do you compete for employees in this environment too? I mean, especially across the different environments that they can choose to work in. How do you go about creating a compelling pitch to make sure that even within the expansion that you're eyeing, that people are attracted towards the Krispy Kreme brand, that want to interface with customers day in and day out?
So there's different aspects to our brand, right? So there's the donut production folks and as well as the experience folks, as well as the logistics people that you got to look and how they're dealing with their consumer base. You've got to just make it a brand that people love, that want to be with every day. You got to be competitive in terms of what's the wages that you're paying per hour and how's that going to be across the functional parts. So if you're a driver, how you're competing in that space. And then it's really about the growth opportunity. So when you're in a company of our size, that even today, it's still just 400 plus producing donut shops with a long trajectory of growth, right? The growth across countries. So that becomes a very attractive proposition. I'd love to see that our donut shop managers are now owners, right? So they get experienced D-nut stock and they become very vested in that. We'll continue to look at tools and benefits that are pretty unique to us. And then I think one of the pieces that people love about Krispy Kreme is just the community aspect of it, how we give back. It's built into our DNA from the founder, that's Vernon Rudolph, that wanted to build a donut shop and then give back to the community. So with that aspect and the unique part of being a pretty fun brand all the time, right? So it's always a social media, very entertaining brand. 6 continents. Maybe we'll get to the 7th continent, but that's our Antarctica. So we'll figure out how that's going to work one day. But at the end of the day, I always think about this very simple equation. Happy Krispy Kremers equal happy donuts equal happy customers. That's what we try to do.
That's so true. Are any of your investors or shareholders asking you questions about where the employee base, or if the employee base is paying attention at all to the unionization efforts that are taking place over at some of your competitors right now, and how you would approach that situation?
In a global business, we do have union partners that we work with along the world. So it's not something that we're not used to working with unions. At the end of the day, I'm always about how do we make sure we keep our Krispy Kremers happy and growing and career paths as we continue to evolve.
Hey, Mike, are you opening in Brazil? When does that happen? That deck, that slide, part of the slide, really took me by surprise. Some of the surprising markets you're opening up internationally soon.
Yeah, so again, we're just in a little bit of dialogue sometimes with the right partners. That'll be an enormous market for Krispy Kreme. There's a love and passion for the sweet treats down in that country. Yo no falo portugués muy bien, soy mexicano, but it's pretty close. But I love the country. I love the passion. As we start to really build a international business, and Brazil clearly is on our radar.
All right, we'll leave it there. Always good to get some time with you. Krispy Kreme CEO Mike Tattersfield alongside our very own Brooke DePalma.
I'd like to just say thank you to all the Krispy Kremers and Insomniacs, and I hope you guys have a happy holiday. And here's my ugly sweater that I wear every day.
Thank you for wearing that on camera. You're now getting beamed out all over the internet. Mike Tattersfield, always good to see you, brother. Be good.
All good. Take care.
All right, before we head to break, let's get a glimpse of Nike ahead of its December 20th earnings release. Deutsche Bank analyst Gabriela Carbone striking a cautious tone on the report, calling out profit margin pressure amid increased industry discounts. Added Carbone, we believe ending inventory will be key with investors looking for an improvement in order to get comfortable with the margin trajectory for the remainder of the year. Coming up, a violation that could set NCAA athletes up to unionize. Brad is back with a look at that, plus more of today's top headlines next.
Let's get down to business. Here are some of the headlines that we're watching for you this morning. Here's the first. The U.S. National Labor Relations Board's General Counsel Office finding merit in an unfair labor practice charge brought by the student athletes at the University of Southern California. This comes after the NLRB's top lawyer issued a legal opinion in September last year asserting that college athletes should be classified as employees when providing services that generate profits through athletic activities held by their schools. Now, this opens up a potential pathway to unionization for the student athletes. And French proof of reserve audit services provider Mazars Group is now halting all work for crypto clients. This as regulators are putting crypto firms under a magnifying glass and as confidence in crypto falters despite its asset verification reports. Mazars Group is providing services, or has provided services at least, for Binance earlier this month, but has recently removed audit data for Binance from its site. The accounting firm's client list also includes Crypto.com, KuCoin, along with other large exchanges. This delivers a major blow to the industry as crypto companies have claimed the big four firms are unable to sign deals with them or even audit a crypto exchange. Though Coinbase works with Deloitte for its statements. And the U.S. Senate passed legislation Thursday authorizing a record $858 billion in annual defense spending, $45 billion more than proposed by President Biden. Senators supported the National Defense Authorization Act, or NDAA, by an overwhelming 83-11 bipartisan majority, and it also rescinded the military's COVID vaccine mandate. The NDAA now heads to the White House, where Biden is expected to quickly sign it into law. Saz?
Beijing's sudden rollback of its COVID restrictions across mainland China is now causing a new set of economic challenges. Yahoo Finance senior healthcare reporter Anjali Kamlani has been following this closely. Anjali.
That's right, Brian. So we know, of course, that China rolled back a lot of its restrictions, including lockdowns of neighborhoods and cities. And what that has resulted in is, not unexpectedly, a labor shortage in a lot of locations, not being able to mitigate the transmission in areas. Though, to be fair, China is also facing a very transmissive Omicron subvariant right now. And so all of that put together really leads to the tale of really what we saw here in the U.S. some time back. And it could spell trouble for the winter ahead for China as they're looking at the potential of yet another wave. They've already sort of been in the middle of one. We saw cases rise, but with the reduction of tests and testing sites, but the increase of fever clinics, there's some guesswork as to actually how many cases they are currently seeing and what the severity is as of right now. So keeping an eye on that. Meanwhile, of course, keeping a track of all the vaccine information here in the U.S., Pfizer just got fast track approval for its COVID and flu combo vaccine. And that is compared to Moderna and Novavax, also in the race for similar ones. Novavax said it should be also applying for fast track approval later on. Moderna unclear yet. So it's going to be interesting. We might have, yet another COVID vaccine race.
Interesting. And also interesting, Anjali, tracking shares of Guardant Health, not a name we usually talk about here, but down about 30% or so here.
That's right. So Guardant Health, they are developing a colorectal blood cancer test. And the results that came out were just shy of what analysts were expecting. They were looking at an 85% sensitivity. By comparison, the result came out as 83%. Now, I'd like to point out that there's another one that JPM pointed to, which has already on the market, already got FDA approval with 68% sensitivity. So if you do, a comparison side by side, there is potential still for this on market. And we know, of course, Exact Sciences is another one in the race. Their share shot up as a result of the underwhelming results here. But they also, they're looking at a much higher sensitivity rating in the 90s. So by comparison, they're sort of betting on which one has the best sensitivity. And the important part about that is basically how many times it could possibly give a false positive. That's sort of how you look at it, and how many times it gives the right, the rightness. We learned a lot about this with COVID tests, as you remember with the at-home test. So that's where the focus is right now.
All right, name we will continue to track here. Anjali, thanks so much. All right, coming up, another big reveal is here. Jared Blickery has analysis on one of Yahoo Finance hottest tickers of this year. We'll be right back. The housing market has begun to cool off in some areas, but our next guest says sky-high real estate prices led young people to invest elsewhere, many turning to crypto. UBS Global Wealth Management Chief Economist Paul Donovan joins us now. Paul, good to see you here. My Twitter feed has been around the clock on discussing this note you and your team put out here. Before we even get into it, what made you sit back and write this?
Well, funnily enough, it's delving back into the mists of time when I began my career as a junior economist here at UBS covering Japan. And of course, Japan in the early 1990s, the younger generation were effectively locked out of the housing market, and they turned to gambling and to high-end consumption, because what was the point of saving for a house deposit if you were never going to get enough money to do it? And looking at what we've been seeing with crypto and also with meme stock investing and the very strong bias to younger people getting involved in this, it did seem to me that there was some kind of correlation going on here, just as I'd seen in Japan 30 years ago.
And so for a lot of people who have to take losses on crypto over the course of this year because of those investments, what does that mean on the other side for what they were hoping to be able to pull out of those investments, perhaps to eventually put back into a home?
Well, so I don't think necessarily that a lot of the younger participants have regarded these as investments, not in the sense that a proper asset is an investment. Instead, they have regarded these as a gamble. And that's very, very important, because let's face it, if you've decided, look, I'm never going to be able to save up a deposit for a house, I'm never going to be able to afford to buy a house myself, then you have a choice. You can go out and blow the money on a new television or a holiday, or go and have fun, or you can gamble with it in a speculative way. And that has to have an element of fun about it as well, because you're competing with, holiday, invest in Bitcoin. I mean, which do you choose? And that's why things like the sort of the cult atmosphere around a lot of this crypto, the message boards and the community and all the rest of it, it creates that element of fun. But that means that the losses are not necessarily the same sort of impact that a loss of a proper investment would have.
So is interest in buying activity in crypto, and I'll even add meme stocks here, is that holding back the full potential of the housing market?
I don't think necessarily you can say that, because the housing market has sort of priced out a group of younger participants. And of course, the point of this research is it's not unique to the United States. I mean, we were looking here using BIS research on crypto ownership at a number of countries. And it's very, very telling that any country where you see an increase in unaffordability of housing, those tend to be the countries where you get the biggest increase in activity in crypto from the younger generation. I mean, essentially, it's men under 35 who live with their parents that are buying crypto. And so this sort of pattern is something that we've been seeing. It is a function of a housing market where you have perhaps a shortage of supply, you've got strong demand, you price out a certain group in that society, and then they simply change their preference and say, oh, well, I've got to wait to inherit property. I'm never going to be able to buy it myself. What else can I do with my spare cash?
Paul, I'm going to go left field here. When you think about what the housing market could benefit from with regard to blockchain technology and how that could revolutionize even the home buying experience, even the selling experience and deeding later on even for those assets, and knowing almost to a granular detail level exactly what has gone into a piece of property, what goes through your mind, and how long out could that be achieved at this point? How far are we from seeing something realistic come to the table?
Well, I mean, I think the thing about blockchain, what we've got to remember is blockchain is designed to be inefficient. That's the whole purpose, because you've got to prove the ownership and so on. There are sort of inefficiencies built into the system. And so when we look at a lot of countries which have got established rule of law, very established property rights. I mean, we go back to the Doomsday Book over here in the UK. The necessity of putting property on the blockchain. I mean, if I want to find out how much my neighbor paid for their house and how much of a mortgage they've got on it, I can do that. I can go to the UK Land Registry, go online, takes 30 seconds, you've got to pay a small fee, all that information is available, there we go. So I don't think that necessarily in that sort of situation, adding blockchain makes the remotest bit of sense, because we've already got all the information we need, and it's far more efficient doing it in the way that we do it. Where you don't have rule of law, where you've got a more anarchic situation, there perhaps things become a little bit more significant. And there, the security of being able to prove ownership suddenly becomes more meaningful.
UBS Global Wealth Management Chief Economist Paul Donovan. Paul, thanks so much for taking the time here today, and have a great weekend. Guys, we're counting out the days to the new year and taking a look back at some of the trending tickers along the way. Today's focus, NVIDIA. Yahoo Finance's Jared Blickery joins us now. Jared.
Hi there. Well, looking at our top 10 here, NVIDIA is number 9. That is number 9 as of last Friday. And I'll tell you what, NVIDIA has been a mainstay of the Yahoo Finance trending tickers for years, but it only topped out at about number 4 this year, and it did that on 2 separate occasions. I'm going to pull up a chart here in a second. First of all, NVIDIA down about 2.5% today. Just the latest news. Powell under fire here and chip stocks under fire as a result of the Fed kind of amping up that hawkish rhetoric. We're going to take a look at the sector in a second, but here's NVIDIA over the last 2 years. This chart is going to look very familiar. Lots of pandemic era charts look like this. Here's the big rise in 2021, only to be met with the huge decline in 2022. Now, at the highs, NVIDIA had a stock price of $384.33 with a market cap of $834.4 billion. And when we think mega caps, don't usually think about NVIDIA, but it actually surpassed Meta in market cap on February 7th of this year. So NVIDIA was $618.2 billion that day. Meta, because it had one of its worst days in years, it had a pretty bad year, that was a day where it sunk to $612.2 billion. Finally, at the lows of the year here, and that was only about a month and a half ago when the rest of the stock market bottomed, here we have NVIDIA hitting a new 2022 low in market cap as well of $279.6 billion. And just looking at some of the mega caps overall, let's hear it. Here we have, this is an intraday picture of them along with their market cap. So here's NVIDIA at $411.6 million. You can see where it fits into the grand scheme of things. Bigger than Walmart, but still smaller than Exxon here. And we know that those energy stocks have been some of the year's biggest gainers. And in fact, when we take a look at the year-to-date performance here, let me just slap that. We can see, indeed, NVIDIA among some of the worst performers of the year here, down 44%. And I just mentioned Exxon. What a contrast. That's up 69%, but pretty much in the same group as Amazon and not quite as bad as Meta, guys.
All right.
By comparison.
Continuing to look back at some of the key performers of the year. Jared, appreciate the time. Guys, coming up, we're going to get a pulse check on the state of the consumer ahead of the holidays with an analyst from William Blair. Next. Retail sales came in lower than expected yesterday, suggesting consumers are feeling pressure from higher interest rates and elevated prices. For more on how that'll play out over the holiday season, let's bring in William Blair Equity Research Group Head for the consumer sector, Sharon Zakfia. Sharon, great to have you here. First, you just actually published your 52nd edition of your Consumer Pulse Survey. What was the biggest finding that you were able to take away from or about consumers going into this holiday season and actually amid it?
Yeah, I think generally holiday spending will be good, but we are seeing consumers appear a little bit more fragile as we get closer to the holidays. So if we look at November versus December, we're definitely seeing more pressure on the consumer and the way they're answering the questions in our survey. That's more acute for household incomes under $100,000, as well as older consumers. So consumers over 45. We're actually seeing household incomes over 100,000 and those under 29 feeling pretty good, even on a year-over-year basis. So we're seeing bifurcation here. I think we've been seeing kind of bifurcation all year in the way the consumer has been approaching spending.
Sharon, I was reading your survey, and I couldn't help but to think back to what United Airlines CEO Scott Kirby told me earlier in this week. He told me he sees pre-recessionary vibes or numbers in his business right now. Are you seeing any slowdown in travel, and what companies are most at risk if we do get that slowdown in travel?
So, I mean, I think travel, you have to think about business versus leisure. I think business travel is still on the upswing. Leisure travel has been really, really strong all year as consumers have kind of gone back to pre-pandemic travel patterns. You know, it's hard to say. We're still really early in kind of the outlook for 23 as it relates to travel. Most consumers travel more in the summer when kids are off, from school. So, I'd say there's mixed signals there, but off of a very kind of solid 22 metric for travel. But when you think about travel, you have to think globally as well. I mean, the American consumer is arguably in much better shape than consumers in many other regions of the world. And most companies you're talking to have a global presence. So they might see European fragility or still the impact of Chinese travel restrictions on their businesses, which would be different than a company that was catering entirely to the American consumer.
Consumers right now continuing to lean into buy now, pay later services. What should we extrapolate from that and how people are buying products versus some of the services that they're seeing as necessities or have to pay for?
So we don't track buy now, pay later specifically in my group. We do track the amount of credit card usage that consumers are using, this year versus last. It's actually, from our survey, coming down a bit for the Christmas holidays. So that's arguably a good sign, also maybe a sign that higher interest rates are scaring consumers away from using the credit cards as much. But for those that are using credit cards, they're using it more. So again, mixed signals. I think this year has been a lot of mixed signals as it relates to the consumer. But arguably, if you look at overall retail sales trends, and I know it's tempting to look at sequential or versus last year, but if you take a longer term and look at the last 3 years, retail sales, even excluding inflation, are outpacing the 3 years prior to the pandemic. So the consumer, given everything that's been thrown at them this year, is still in pretty good shape.
And Sharon, your research calls out a couple of winners and losers. Some winners are like a TJ Maxx, a Lululemon, but one company that may be starting to just hit the skids a little bit is Yeti. Why is that the case?
So Yeti had a great 21, and these surveys are designed to look at holiday sales year over year. And Yeti was expecting a slowdown in holiday sales this year, so I don't think it's out of keeping with expectations. As we look into next year, we're expecting Yeti to do fine, but probably not replicate the 21 performance that they had, where sales were up nearly 30%. I mean, the company's long-term growth plan is to grow 10 to 15% top line, and we're seeing more of a normalization, I think, to that rate.
All right, we'll leave it there. William Blair, Equity Research Group Head, Sharon Zakfia, always good to see you. Happy holidays.
Thank you.
Okay, the final few shopping days for the holiday season are here. Tanger Allard CEO stops by to share what he has been seeing in his business this month. Don't go anywhere. Holiday shopping at Tanger Outlets is in full swing. Shoppers look to get a bigger bang for their buck. In the face of inflation, the outlet chain saw record numbers over the Black Friday shopping weekend and remains optimistic about discount shopping trends. Let's bring in Tanger Outlets CEO and President Stephen Yalof to talk shop. Stephen, good to see you here. So you've been out there touring a lot of your locations. Has the holiday season lived up to your expectations?
Yeah, I think it has. Again, you go back to 21, and I would just listen to the last piece that you had, and everybody's talking about sales expectations for 21 being some of the best that retailers have seen in quite some time. And actually comping 21 seems to be a pretty good trend. And now as we look at our traffic, particularly coming out of Black Friday and going to December, we're starting to see it build and build higher than that 21 trend year.
What would you typically track against with regard to that traffic in prior recessions and kind of using where the consumer mindset is, where sentiment is prevailing at this point to compare back to previous times to determine where foot traffic is either higher versus previous recessions or lower at this point too?
Sure. I mean, look, the most recent recessionary headwind we faced was back in 2009. And, as our founder likes to say, in recessionary times, people are looking for value. People are looking for value every day. Yeah. But particularly when there's a recessionary headwind, people are really looking for value, and we're a great place to shop.
You exited your most recent quarter with an occupancy rate of 96.5%. That is It's pretty darn high. How have you managed to fill up all these locations?
Well, there's a couple of strategies. First of all, if you take a look at the direct-to-consumer brands that have recently executed bricks and mortar stores in full price environments, both streets and malls, what we're finding is those direct-to-consumer brands are now finding the outlet space. And they are because they find it as a place where they can come in, do a full brand expression of their product without brand dilution that you might get if you put your product in some other secondary channels that are a little bit more mass. So those are great sources. Additionally, we see a lot of our better performing retailers expanding in our space because these stores have been truly productive for them, especially since COVID, where they continue to ramp up. Our shopping centers are open air environments, and again, great brands at value pricing every day.
We're seeing kind of a reinvention of shopping centers, and there's more of a lifestyle component that gets added into it. What have you heard from non-retail companies who are trying to move into those spaces too?
Well, I think that's a strategy for us too going forward. You know, the old narrative of the outlet center was the power shopping experience. You would go from store to store to store, grab a pretzel and go to the next store. And here what we're finding is people are doing a little bit more research online. So we're engaging through our digital initiatives to give more product and more visibility to the things that we're selling in our outlet centers online. And so when the shoppers come, they at least are a little bit more targeted, but they're also looking for more things. And we've also learned, if you do a little bit of that study of the things that you learned during the COVID period of time, what we're also finding is that people are looking for a better food experience, for sit-down restaurants, better amenities, more entertainment, and we're executing to that as well. Most recent example of that is the Dave & Buster's that we put in several of our shopping centers.
Do you see those non-retail customers of yours as more profitable in those shopping center spaces too?
Well, we see a customer who stays on property longer will definitely ultimately build a bigger basket and execute to a higher sales volume for us.
As the rents for your tenants, they reset next year and going forward, what does the pricing look like for those rents?
Well, we reported in our last quarter earnings report that our rent spreads on a blended basis, and that's the indication of the rent that you get from a renewing tenant to their new renewal set, or from a re-tenanting, and that means a new tenant taking a space that was previously occupied by somebody else. That blended number has grown 5%. And that's 18% on re-tenanting and just under 4% on renewal, which for us, we've had 6 consecutive quarters of growing rent spreads, and we'll continue to grow our rents.
This may seem like a random question, but for a lot of the shoppers that go into these experiences too, their cars are sitting idle for a long time. We've heard a lot about spending into these experiences to make sure that you can have people be able to recharge their cars while they're even on premise there.
That's right.
What kind of shift does that mean for you infrastructurally over at Tanger?
Well, our ESG initiatives are extremely important to us, and the 2 things that we dug into over the last 2 years is, first of all, raising our solar footprint. So we've doubled our output from a solar point of view, and a lot of our shopping centers are in the southeast, so it made it a lot easier for us to execute. But one of the things that we're truly proud of is we have EV charging in every one of our shopping centers. So we're part of that EV charging network. And as a driver of an electric vehicle, I find it very convenient when I pull up into one of our shopping centers and I'm able to charge my car while I'm waiting.
Last one for you here. Are you seeing a lot of retail crime in the outlets? It's something I've been writing a lot about here, and I look at a company like Target. I mean, they're calling out a $4 million hit this year because of inventory shrinkage, which in their view is people going into these stores, maybe breaking a display and walking out with merchandise.
Yeah, you know, that's been a big issue across all channels, from streets to malls to the open air environments that we're in. And, you know, we take our security extremely seriously. And, you know, fortunately for us, the incidents, at least in the last 6 months, have curbed substantially, and we're thankful for that. But
because of more security, you've put more people.
Well, we have put some more security, and particularly around the holidays. And a lot of our retailers are also a little bit more putting more security in their stores as well.
Tanger Outlets CEO and President Stephen Yalof, thank you so much for joining us here.
Thank you for having me.
Appreciate it.
Great. Happy holidays.
Happy holidays. Coming up, New York is putting its foot down on sales of cats and dogs at pet stores. We're going to discuss that next. Welcome back, everyone. Time for Cut for Time. 3 stories, 1 minute each. We start with this today. The Washington Commanders ownership reportedly moving forward with a potential sale, with Bank of America poised to send what amounts to a prospectus for the team qualified potential buyers. That, according to the Washington Post. Now, this has been, of course, in focus for a while, with many fans, a lot of team executives wanting Dan Snyder to sell his stake in the Commanders for a long time, and that finally moving forward here. And of course, the change of the team name a couple years ago too. So there's been a lot of change over at the Washington Football Organization.
Yes, well, Dan Snyder is probably arguably the Eddie Lampert of owners or CEOs of football. I mean, he's just done an abysmal job under his ownership here. So you would have to think fresh blood, new insight, new people there are long overdue for this franchise. But you have any of these players on your fantasy team, Brad?
I don't have any of these players on my fantasy team. Thank goodness. That means I don't have to watch any Commanders games this season.
No, that's a tough crowd.
As an Eagles fan.
I'm not following the Commanders, but of course following this deal here at Yahoo Finance. All right, a 46-foot high aquarium housing 1,500 tropical fish has exploded in Berlin. Wow, flooding the Radisson Blu Hotel and surrounding streets with millions of liters of water. Dubbed the Aquadome, it was the largest freestanding cylindrical aquarium in the world. This is horrific. This is a horrific way to end the show. Terrible to see things like this. It's just awful images there.
Yeah, there were 2 people who were injured within this, and of course, with any type of aquarium that size, a lot of glass as well. Now that they have to kind of survey the area, make sure. I mean, this is going to be quite a cleanup process, to say the least. But fortunate that there were really only 2 injuries that it seemed like were sustained from this, and they seem to be relatively minor from what I read up on this. But
do we know what caused it?
I don't know. There might have been I know that there was a reconstruction, and they tried to add, or did successfully add, an elevator that was also, I believe, running through that aquarium too, or at least somewhere nearby it. So the pressure might have been thrown off a little bit. Yeah. Also, New York is saying no more to the sale of cats, dogs, and rabbits in pet stores. The law will take effect in 2024 and join several other states in animal welfare pushes to start shutting down large breeders here. Now, I have only seen a few pet stores in New York, but again, you walk in there and
well, before I talk about any pets, Brad, I always say, I pour one out for my dead dogs that given me a lot of love through the years. I've had a lot of amazing animals. But growing up, this is where we got. I went to the pet store to buy animals.
Where you got?
Yeah, that's where we got our animals at the time. There were a lot of them where I lived, and purchasing a pet was big money. It was a big money purchase, especially for my family.
Yeah, I grew up in Pennsylvania. We went out to Lancaster and got our dog that became part of our family. And so now I think a lot of that will shift probably towards many of the farms. Maybe this is good news for Lancaster, Pennsylvania. I don't know.
Yeah.
But they're still
But
breeding
it's a sad way to end the show.
I hate
these last 2 stories.
I
think Julie Hyman's not here. I have to talk about this stuff.
Well, something that's still sad is the market.
All right, as they say, switching gears. Coming up, we'll have Kiko Fujita and Rochelle Akufo for What Just Happened, our What Just Happened special on the collapse of FTX. Right now, we're seeing all 3 major indices continuing that sell-off that started post-Fed earlier in the week. Have a wonderful, wonderful week.
Be happy.
one of the biggest financial frauds in American history. FTX, a $32 billion empire, worthless.
There's a lot of people that are not happy about this, and I'm one of them.
The man once dubbed crypto's white knight, criminally indicted. A stunning turn for a story that grabbed the headlines for months. The man tasked with saving crypto, ringing its death knell? From the euphoria of 2021 to the turbulence of the past year, is it on life support?
And it's a choice. They have chosen to try to skirt the law.
The Super Bowl dubbed the Crypto Bowl. Celebrity endorsements from Larry David to Tom Brady. Then the great inflation hedge no more. Central banks tighten policy and the capital drains out. Crypto's market cap slumps from $3 trillion to $1 trillion. The collapse of the Terra stablecoin an early warning, but the damage real. Its founder still on the run today.
As crypto values crashed and platforms began to fail, FTX and Alameda found ways to benefit.
By late June, Bitcoin below $20,000. Contagion spreading. Sam Bankman-Fried comes to the rescue of troubled lender BlockFi. This, the tip of the iceberg. 3 arrows, Voyager. An industry borrowing from each other to make risky bets. All the while, crypto assets plummeting.
FTX and cryptocurrencies are not the same thing. FTX was opaque, centralized, and dishonest.
Then, the industry's so-called central banker, SBF, catastrophically falls from grace. By November the 14th, it was history. The exchange had collapsed.
Instead of the Wolf of Wall Street, they'll make a movie called The King of Crypto.
The world's most unlikely billionaire now facing a litany of criminal charges and more than 100 years in prison. SBF now discussed in the same breath as Bernie Madoff. Is crypto more than one man, or was it all built on a house of cards? Welcome to Yahoo Finance. This is What Just Happened. I'm Akiko Fujita.
And I'm Rochelle Akufo. Now, this is our deep dive into the biggest story of the week and how it impacts your investments in more ways than one.
This week, the collapse of FTX, leaving the crypto world in a state of disarray as Sam Bankman-Fried's empire comes crashing down. And of course, this was the week, Rochelle, where we saw prosecutors hone in on Sam Bankman-Fried, the former CEO now of FTX, arrested over in the Bahamas, indicted on 8 counts of fraud, as well as, we should say, financial and elections fraud. On the very day he was expected to testify before Congress. Now, we did hear in his absence from the now current CEO, John J. Ray, giving a damning testimony against FTX, saying that this was a case of good old-fashioned embezzlement. Now, while the focus has largely been on FTX, we're going to attempt to sort of pull back here over the next hour to take a look at what this means for the crypto space. What does it mean for the future of digital currencies? And more importantly, what does this mean for your money if you are, in fact, invested in crypto? And Rochelle, it's worth pointing out, the key question here is was this a one-off? Was it just about Sam Bankman-Fried and FTX, or is this a symptom of a larger problem within the space?
And I think that's what the crypto community right now is trying to decipher. Was this one bad actor? Was this him plus his inner circle? Was this all these people who relied on other people's due diligence not doing their job, or perhaps some of this patchwork regulatory that we have that allow for this to go on for as long as it did? So a lot of people pointing a lot of fingers here, but it's interesting to see we're still seeing, Bitcoin and Ethereum, Ether doing well today, still progressing, although down a little bit with the broader markets, but not being as affected as you would expect, which does make you wonder how much of this is about crypto versus, say, the individual platforms or SBF himself. But as we've been mentioning, SBF was the golden boy that regulators were turning to. So when we try and think about contagion, and we look at SBF and FTX as trying to be this white knight, this rescuer of the crypto industry, once he goes down, what happens next and who's next? Obviously, we continue to hear about what's happening with Binance as well. A lot of people wondering if perhaps Binance could be next.
And of course, Rochelle, there are still questions within FTX. You know, we got these reports this week about insiders who were among the senior executives who turned on Sam Bankman-Fried himself. So we still haven't seen the full story here of FTX and how it collapsed. Of course, the allegations at the center of this remain that FTX did, in fact, commingle its funds with Alameda, which was also owned by SBF. So still a lot of slices that are question marks here, but there's certainly a lot of questions here about what this all means for the space moving forward.
Indeed, and we'll try and get those answered for everybody today, because as investors try to navigate the turmoil in crypto, the question is, where do we go from here? We want to bring in Hillary Allen. She's a law professor at American University's Washington College of Law, and she addressed the Senate Banking Committee just this week. In her remarks, she emphasized to lawmakers the importance of limiting the growth in crypto, saying blockchain technology could never deliver on the industry's promises. Let's also bring in Yanis Varoufakis. He's an economist and politician leading the Greek political party, Mera25, and a former finance minister. Yanis has been outspoken on the challenges for Bitcoin adoption, saying it can never be a currency, though he's more optimistic on blockchain technologies as a whole. A big welcome to you both. So, Hillary, I want to first start with you because of your testimony here, because you did make it seem as if it wasn't just a one bad actor, that perhaps if the regulatory patchwork had been better, if crypto itself hadn't been so opaque, this alleged embezzlement and fraud wouldn't have been allowed to continue as widely as it did. Break that down for us, but some of the nuances that make crypto different from, say, traditional fraud.
Well, the key thing I focused on in my testimony that's different about crypto is that these assets can be made up out of thin air. They have no productive capacity behind them. And so when you start with that, it makes it much easier for fraud to grow, because what kind of metrics are you going to rely on to figure out whether it's a good investment or not? If you look at how market capitalization is calculated in this space, it's you know, you issue one token, maybe you buy it from yourself, you take that price, you multiply it by the entire supply of tokens you've created, and that's your market capitalization. You know, that's a space where it's very difficult to figure out what things are actually worth. And also the ability to create assets out of thin air creates a lot of leverage in the system and makes it very fragile. And that's why I think it's fair to say that this is not a problem that is unique to FTX. This is symptomatic of the entire crypto industry.
Yanis, I wonder if you can respond to Hillary's claim there, because you have been quite critical, saying that Bitcoin can never be a currency. I mean, what is the use of Bitcoin? What have we learned about that specifically? Because there are those who would argue that FTX isn't about Bitcoin or Ethereum. This is about a bad actor who used those digital assets as cover to commit fraud.
Hillary is absolutely right. When you combine mind-numbing complexity with self-referential promises in a financial market or product, you end up with Ponzi schemes. And this is exactly what has happened. But we must separate in our mind, on the one hand, something like Bitcoin or Ethereum, aspiring cryptocurrency, from securities that are built on them, bets, wagers, complex wagers that are synthesized from aspiring cryptocurrencies. The reason why Bitcoin is not suffering as a result of FTX's collapse is because they are quite separate things. Bitcoin has its huge challenges. I have, as you said, since 2008 have been saying this is not a substitute for fiat money, never can be, and never should be. But at least there are uses to it, and there are potential uses that can come out of the blockchain distributed ledger technology that have nothing to do with cash. But then when you are looking at something like FTX, what you're looking at is the, the state of the world prior to regulation in the financial industry. The idea of conjuring up out of thin air values and creating bubbles which then burst, leaving lots of shattered lives behind. We saw that in the banking system in the 19th century, and that's why you had regulation. So the great debate now happening in your country and elsewhere concerns whether crypto should be regulated or not. I believe it shouldn't be regulated. I believe that you should let it burn. And those who, want to experiment with cryptography, with distributed ledgers, should take the risk.
So Hillary, then, is having decentralized currency or having a decentralized platform like this, is that even actually possible then?
So I agree with a lot of what was just said. What I don't agree with is that there's any benefit in the distributed ledger technology. Its promises are very appealing. I can totally understand why people would like to have decentralization, but the reality is that this technology cannot achieve it. Basically, it can't scale. Anything that's truly decentralized cannot scale. If you think about sort of how the Bitcoin blockchain works, for example, the way it tries to repel bad actors is by being purposely cumbersome and clunky so that it's too hard or too expensive for someone to take it over. So inherently, anything that is a decentralized ledger is going to be less efficient than the centralized alternative. And so what happens? We start to see centralization of the things that were previously were designed to be technologically decentralized. You've got to realize that economic and technological decentralization are different things. And when there's money to be made by providing centralizing services, then that's going to happen. And I think Tim O'Reilly, the great internet pioneer, has said that he's never seen any technology centralize as rapidly as the Bitcoin technology. So I guess I would say it's not centralized. And I do have it's not decentralized, it is centralized. And I do have some sympathy for the position that, maybe we should let people tinker with this stuff if they're interested in it. The problem is that they can't tinker with it without causing negative externalities for others. There's environmental costs, there's a lot of ransomware being done with this technology. And, a lot of people were duped into thinking that this was something more than, an interesting experiment. And so I have sympathy for the let it burn position, but I don't think it's morally or politically tenable given how many people are being suckered by this stuff.
Yeah, Yanis, let me have you respond to that. When you say, putting Bitcoin and Ethereum aside, the other crypto assets shouldn't be regulated. I mean, what about those that Hillary just mentioned? Those who bought into this myth, who are now counting their losses, who's going to be held responsible for that?
I'm tempted to say they should. They should have known better. They should be more careful with what they do with their money. But that might sound too cynical. I do believe that there should be public information campaigns warning people of what might happen if they invest in crypto that conjures up values out of thin air. You see, the problem is this. In liberal societies, we do not want to ban people from conducting interesting experiments. On the other hand, the big question is, should we regulate it? If you regulate it, suddenly you create links between this fantasy world of cryptocurrencies with the rest of the financial system. And it is perfectly possible that given the failures of regulation, we saw what happened in 2008 in Wall Street, the whole house of cards came down, even though it was supposedly regulated, then you may find that experiments gone wrong in the crypto universe will have detrimental effects to the rest of the financial world and the real economy. Do we want that? One last comment, if I may. Distributed ledger technologies work quite nicely. Hillary is right, not at great scale. Well, that can still be useful. Already, bankers and several insurance companies find uses for distributed ledger technologies. I have experimented personally with distributed ledger technologies for them creating transparency when it comes to fiscal money, what I call fiscal money, or transactions based on the fiscal authorities' websites and systems. There can be uses. Ethereum is a much more interesting experiment, as far as I'm concerned, than Bitcoin, because you can actually trade in contracts. Besides that, I do believe that the great question for all of us, from a societal point of view, is: do we regulate it, do we ban it, or do we let it evolve on its own?
Yeah, a question or many questions that I know lawmakers, at least in the U.S. and definitely globally, still grappling with. Appreciate both of you joining us today. American University Professor of Law Hillary Allen and Yanis Varoufakis, leader of Greek political party Mira 25. Thanks so much for joining us today. Well, let's now get to Jen Schomburger, who's going to be telling us what happens next on this week's What Just Happened. Jen.
Hey there, and coming up, in the wake of FTX's failure, lawmakers doling out the pain in congressional hearings, but how will they approach actually writing rules when the pen meets the paper? I'll break that down next.
The hearings will pretty much illustrate the fact that there was lax regulation.
They just need clear legislation and regulation in terms of who has regulatory purview, what makes a commodity, what makes a security.
Does the SEC, in fact, have jurisdiction over cryptocurrency? Is it really a security?
The CFTC and SEC, which, both of whom to a degree say that they have the statutory authority to regulate this. But when you're talking about depository insurance, you're really talking about the FDIC, the OCC, and the Federal Reserve.
There is a real quandary here about whether existing regulatory frameworks are going to be sufficient.
Well, those were just some of the voices previously on Yahoo Finance showing just how difficult it's been to enforce existing rules to regulate and protect consumers and investors in this new crypto world. The problem remains, current rules have not prevented a meltdown, and the Securities and Exchange Commission is facing calls for new rules and clarity. Lawmakers on both sides of the aisle pointing fingers at the SEC over FTX's meltdown, while also proposing their own legislation. When asked during a recent interview whether it was finally time to write rules tailored to regulating crypto, SEC Chair Gary Gensler wouldn't say. Instead, he told me existing security laws are in effect and that the agency will enforce them, noting that the SEC has taken 100 enforcement actions total against crypto firms. The chair told me he has one goal when it comes to regulating crypto next year, making crypto exchanges and lending platforms come into compliance. Take a listen.
They can do that appropriately, working with the SEC, or we can continue on the course with more enforcement actions, and I would have to say that the runway is getting shorter.
And now any real change in crypto rules would need to come from Congress. But Cowen analyst Jarrett Seaberg says he doesn't think Congress will act quickly. Rather, they will lay the foundation in 2023 for real action in 2024. Echoing that, Senator Cynthia Lummis, who has co-sponsored one of the most comprehensive crypto bills to date, told me lawmakers shouldn't have a knee-jerk reaction and is combing through her bill again for any changes in the wake of FTX's failure. Senate Banking Committee Chair Sherrod Brown intends to advance his own crypto legislation next year. He wants to develop a comprehensive framework that looks at crypto products for what they are, quote, not what crypto executives want them to be. He says lawmakers need to look at conflicts on crypto platforms that combine multiple functions like trading, custody, and exchange. He's also calling for better disclosure that allows investors to understand how a token works. He thinks existing banking and securities laws are a good guide. Meanwhile, Senator Elizabeth Warren is proposing a new bill that would crack down on crypto money laundering by imposing safeguards for crypto crimes on crypto trading, including know your customer requirements for digital asset wallet providers and miners. And on the House side, House Financial Services Chairman-elect Patrick McHenry has 3 priorities for crypto regulation next year. He wants to bring clarity of treatment to crypto. He wants to establish a framework for trading platforms, and he wants to develop a federal framework for stablecoins, something that he has been working on with current chairwoman Maxine Waters, though that has been delayed since this summer. While the wheels are in motion on Capitol Hill, it will take time to pass these new rules. And now over to Akiko Fajudo.
Yeah, Jen, that was a long list of options you just laid out. They're certainly pointing to how fragmented the conversation's been so far in D.C. So is the idea that existing rules are fit to regulate crypto, like putting a square peg in a round hole? Let's bring in more on the conversation. Closer look at the SEC's approach with Howard Fisher. He's a former senior trial counsel for the agency and a partner at Moses Singer. Howard, I don't know which slice of all those regulations she just laid out we want to tackle, but I want to start with this point that we just heard from Yanis Varoufakis and Hillary Allen in our panel in the last block, who said essentially, there are so many tokens out there. Some should just be left to burn, that they shouldn't necessarily have to be regulated. How do you respond to that?
Well, that's one of the big questions that people are considering. And there are people who say, let's not regulate it at all. Let it collapse. If it does, no real harm. The harm is to the crypto environment, but as long as the crypto collapse doesn't cause contagion to the traditional legacy financial structure, there are a lot of people who say, let it live or die on its own merits or lack of them. And as you point out, there are so many coins, it's impossible to keep track of them. Some of them are trading at fractions of a cent. And so there are many people who say, why should the government expend the time and the resources in dealing with this issue? Let it deal with itself, either by collapsing or by prospering.
And Howard, what's interesting to me is looking at just how fragmented the regulatory landscape is.
Yeah.
You've got the U.S. discussion, which is already fragmented. You've got what's happening in places like China. You've got what's happening in El Salvador. How does that all come together when so many of these exchanges operate in different jurisdictions? How effective can the policy really be?
Well, that's a great point. And if you want to trade crypto, all you really need is a computer connection. And you have companies like FTX who left the US and went to jurisdictions which are perceived to have let's just call it a lighter regulatory touch. Unless there's really some kind of internationally agreed protocol on how to handle crypto assets and how to handle crypto trading and how to handle crypto customers and how we treat their assets, it's problematic because, as you point out, even if we have the best regulation in the US, what does that help if someone will just go on their computer and trade through a platform located in Singapore Singapore or Hong Kong or the Bahamas or Aruba or somewhere where they don't have that regulatory protection. So I think you're right to point that out. I think the answer is not just regulation on a national scale, but on an international scale as well. So if you think it's going to be hard to get Congress to agree on something, just imagine the difficulties in getting regulators of multiple jurisdictions to agree. Good luck on that.
Yeah, let's hone in more on what played out with FTX. Obviously, Sam Bankman-Fried being arrested over in the Bahamas earlier this week. I heard you say something that was kind of interesting about the timing of all of this, how quickly this all came together, in that it was potentially the work of insiders, former executives that could have flipped on Sam Bankman-Fried that allowed prosecutors to go after him. What do you mean by that?
So when I was at the SEC and investigating a large case, there was always a lot of pressure to wrap it up as quickly as possible. But these complex cases take a lot of time. There are a lot of documents, there are a lot of trading records, there are complicated issues, and it could take months, sometimes years, to bring charges. The fact that the various agencies were able to bring charges so quickly in this case suggests to me several things. First of all, that the current management is cooperating very closely with the government and is providing them access that they wouldn't have had if Sam Bankman-Fried had stayed in charge. Second, that there are probably people on the inside, and I say people because it's probably more than one, that are cooperating in exchange for leniency in how they are treated. The third thing is that it may be the case that there were already investigations in place, that there were already agencies, maybe the Department of Justice, maybe the SEC, looking into aspects of FTX's operations for months, maybe longer, and that one reason they were able to do these cases and file them so quickly is that it wasn't just a month, it has been maybe more. And we don't know that, we might never know that, but I think that the speed suggests at least that as well.
Yeah, we're certainly going to learn more here, but good to get your insight today. Howard Fisher, partner at Moses Singer and former senior trial counsel for the SEC. Well, now let's get over to Brad Smith, who's going to tell us what's coming up next on this week's What Just Happened? Proof of reserve, something we have heard over and over, Brad.
Yeah, that's right, Akiko. The proof is in the pudding. With no clear regulation and a lack of real oversight, proving reserves has become even more crucial since FTX collapsed. I'll discuss why and dive into some fresh developments just taking place. That's next.
The FTX Group's collapse appears to stem from absolute concentration of control in the hands of a small group of grossly inexperienced and unsophisticated individuals who failed to implement virtually any of the systems or controls that are necessary for a company entrusted with other people's money or assets. This is really old-fashioned embezzlement. This is just taking money from customers and using it for your own purpose. Not sophisticated at all.
That was FTX Group's new CEO, John Ray, describing the state of the company's financials that led to its demise. And indeed, proof of reserve statements for crypto exchanges have certainly come into question as fear and doubt shadow the very institutions entrusted with investors' money. So much so that even the work of auditors is being closely watched. Mazars, the auditing firm working with Binance and other exchanges on proof of reserve statements, has paused all work for crypto clients after vetting them. Binance confirming this suspension to Yahoo Finance, adding that its capital structure is debt-free and that over the past week it passed a stress test that should give the community, quote, extraordinary comfort that their funds are secure. So in a nutshell, the events seen and experienced for some during crypto winter have centered around proof of reserves and corresponding liquidity. So as defined by Crypto.com, proof of reserves is intended to allow customers a means of assessing an institution's solvency and liquidity in the context of recent developments in the crypto industry, aiming to improve transparency and customer trust. So the decision by Mazars to pause its auditing to crypto firms delivers a major blow to the industry, as crypto companies have claimed the big four firms are unable to sign deals with them or even audit a crypto exchange, though Coinbase works with Deloitte for its own statements. Now, what you also need to know about this is what takes place within that process of the auditing. And there's something that's known as a Merkle tree. Now, this was invented back in 1979 by Ralph Merkle, and this is essentially a commitment scheme within cryptography that really makes sure as you go down from the commitment at the top, the root of it, all the way and in certain layers, as you go layer by layer, ensuring that on each side of that layer and each side of that tree, that there is a balancing of where there was the original commitment. And so that is where the proof of reserve study really moves forward. And so that is where we will see even more focus within this cryptocurrency landscape. On over to you, Rochelle.
All right, thank you. Our very own Brad Smith there. Well, obviously, a lot of people have questions, and for the many retail investors who've been burned over the past month, the damage done will be irreparable. Now, others, like many so-called Bitcoin maximalists, will still want to put their money to work in this space. So where are the opportunities, and what red flags should they watch for? Let's bring in Rick Edelman there, founder of the Digital Assets Council of Financial Professionals and best-selling author of The Truth About Crypto. Rick, thank you for joining me today. So obviously we've heard about the proof of reserves issue that's now come up with Mazars wondering what to do in terms of this auditing. The red flags that people should look out for if they do choose to go through an exchange.
Well, it's, we're talking about this proof of reserves because there's a desperate effort to verify that your coins are where you think they are. The problem with proof of reserves is that it's a momentary point in time. Even if they demonstrate that your coins are in your account as promised, that doesn't mean they'll be there tomorrow. It doesn't mean that they didn't shuffle things around in order to make that proof of reserves accounting look right. The bottom line is, if you're dealing with a centralized exchange, a centralized custodian, unless you have a very high degree of confidence in their integrity, their honesty, their capabilities, you've got to be raising questions. I mean, quite frankly, I'm thrilled that Fidelity is serving as a custodian of Bitcoin because I believe Fidelity is above reproach. But a lot of these new crypto companies that are formed overseas with people who have resumes that are sketchy, who don't even have a fixed place of business or residence, you just have to wonder how much you can rely on even proof of reserves allegations and claims.
So what do you tell clients, Rick, who are saying, I want to invest in crypto? Where do I put my money? And I ask you that because over the last year, you have been really sort of preaching the responsible investing, but also saying that you can't afford to not be invested in crypto because of the growth opportunities. I think you said about 1% exposure before, but what is that portfolio or what should that portfolio look like now?
Yeah, you're right. You're absolutely right. This is very frustrating because the fundamental use case, the fundamental investment thesis for crypto remains as strong as ever. FTX had nothing to do with crypto. It was just another fraud. And we find crooks engaged in every asset class, stocks, bonds, real estate, gold, you name it. And it's a shame that this has happened yet again in crypto. This isn't the first time and it won't be the last. So we do, as investors, have to be very careful. A 1% allocation is all I advocate so that you aren't taking excessive risks, placing your financial future in jeopardy, but giving you the exposure to be able to enjoy the profits that I do believe will yet come from Bitcoin and other digital assets. So how do you do it? Well, you use, as I mentioned, an extraordinarily reliable custodian such as Fidelity, or you use your own cold wallet, such as LedgerX, where you buy your coins from an exchange and you immediately transfer them to your own wallet that you have in your physical possession, stored in your own fireproof safe. Those two approaches, I think, are among the best ways to go, and the most mature, responsible, professional fund companies in crypto, companies like Bitwise and Eaglebrook and others, are doing exactly that. They're custodying with Fidelity. Choice does this as well, an IRA qualified custodian. And this gives you an extra level of confidence that you're not playing with folks who, frankly, have sketchy enough or short enough track records that you have to question not only the safety of the crypto investment thesis, but the safety of the custodian that you're using to engage with.
And Rick, a lot of people are bracing. We're already in the middle of a crypto winter. Perhaps, well, I've heard the term crypto Armageddon potentially for next year, potentially things getting better in the second half of the year. But a lot of advice people are getting from social media, from different platforms, different influencers. What should people keep in mind when they're getting this advice? Being that some people will sort of throw their hands up and say, look, this isn't financial advice, but there are very real consequences.
There really are. And anybody who takes financial advice from a chat room or a tweet, frankly, deserves what happens to them. You really need to make sure you're dealing with reliable, professional financial advisors. There are financial advisors who have demonstrated their expertise. We offer at the Digital Assets Council of Financial Professionals, we offer the certificate in blockchain and digital assets, an online course that with a world-class faculty that allows financial advisors not only to get the knowledge they need to help clients, but to demonstrate that they've obtained that expertise, giving their clients confidence they're dealing with a financial professional who knows what they're doing and is going to serve their best interests. So you need to make sure you're being careful where you're getting your advice, who you're listening to, and watch out for the get-rich-quick, FOMO, FUD attitudes. This isn't about getting rich quick. This is about investing in a new technology that's as revolutionary as the internet was 30 years ago. And if you treat it with the respect and professionalism it deserves, it can be additive to a diversified portfolio.
Well, certainly appreciate you joining us. A lot of people looking for some solid advice here. Rick Edelman, thank you so much. Well, now let's head to Jared Blickery, who's going to tell us what's ahead on this week's What Just Happened. Hey, Jared.
That's right. Coming up, the chain reaction. The implosion of FTX was a big moment, but it was part of a domino effect from Voyager to the collapse of Terra Luna and default by Three Arrows as well. We look to the interlocking tentacles of a risky industry. That's up next. Welcome back to What Just Happened. I'm Jared Blickery. From crypto billions to house arrest in the Bahamas, many timelines start with CoinDesk article in early November. That's regarding FTX's demise, but we can place the beginning of the end for FTX at least as far back as the collapse of the Terra network over the summer. Now, Terra, along with its enigmatic leader Do Kwon, were among the crypto elite earlier this year, but in early May, the price of the Terra USD stablecoin began to crack the $1 peg. This $18 billion market was linked to a companion token, Luna, which crashed. The first major crypto collapse of 2022 didn't immediately seem to involve FTX, but reports now are surfacing. They point to the possibility that FTX and affiliated hedge fund Alameda Research were involved. Now, Terra Luna also brought Three Arrows Capital in the spotlight. The chinks in crypto's armors would be increasingly become apparent, and that's due to leverage. It would also play a leading role in the next crypto fallout, and this time with BlockFi and Voyager Digital. In June, FTX handed over $400 million. That was a credit line to BlockFi after it was still reeling from the Terra Luna collapse. Meanwhile, Alameda Research loaned Voyager Digital $200 million to help safeguard its customer assets. But Voyager, it would file for bankruptcy in July, and BlockFi would now follow in November, along with Alameda and FTX. One more piece of the puzzle also fits in here. Collapse of crypto lender Celsius. Regulators in the U.S. had already come down hard on attempts to pay U.S. crypto investors interest on their crypto holders, the so-called DeFi movement, and Celsius had dialed back its interaction with non-accredited investors early in the year. It might have been a canary in the coal mine. Nevertheless, as a melee in the industry proves too much, Celsius filed for bankruptcy in July, and lots of bankruptcy overall. Lots of leverage, lots of assets up in smoke, and then there was one. And if we can get back to our Wi-Fi interactive heat map here, just want to show you our crypto movements in the year to date. And here we have our crypto heat map. There we go. Year to date, Bitcoin down 65%, Ethereum down just a little bit more, but want to show you some of those tokens. The FTT token that was the centerpiece of demise here, and we can go to a year-to-date chart of that. You can see how quickly that fell in early November. And when I say there's only one that sees these, Binance, guess what? BNB token, and let's see if I can find that here. That suffered a little bit of a hiccup not too long ago. Here we go. You can see that's still down 53% year over year. That's where the chinks in the armor are. Up to you, guys. We're going to pass it over to Alex Simonova next.
Thanks, Jared. So if FTX was built on a house of cards, who helped build the foundations, why venture capital missed so many red flags, and whether anything will change? I'll bring you the story next.
you have a $600-700 million Series A fund, you can't write $2 or $3 million checks in that case. You got to write $10 million checks, $20 million checks, which means the valuation has to be inflated. And then all across the chain, through every successive round, all the way through growth equity, everything remains inflated. It finally hits the public markets. And then the markets usually correctly slash the value by 60-70% because what they got wasn't reflecting reality at all.
That was Bradley Tusk on how VCs rushed to fund companies. Let's focus in on their role now. It appears justice is finally catching up to Sam Bankman-Fried. The disgraced founder of and ex-CEO of FTX is in jail in the Bahamas, a facility described as rat-infested and overcrowded. He faces a wave of charges in the U.S., including wire fraud, conspiracy, and money laundering. But while he appears responsible for the destruction of FTX, there are others who share the blame. The story of FTX is also a story of venture capital carelessness. VCs showered the crypto exchange and its founder with money through generous rounds of funding while failing to demand that proper protections were in place. Sequoia Capital, SoftBank, and Tiger Global, some of the world's most sophisticated investors, all made that mistake. Sequoia wrote down an entire $210 million investment in FTX, while SoftBank and Tiger Global also reportedly lost tens of millions of dollars. VCs and other investors awarded FTX with an estimated $1.8 billion in funding over the last 3 years. That's according to data from CB Insights. Swelling industry assets in recent years placed pressure on investors to compete for deals, and that furious pace of activity meant that investors may not have been doing proper due diligence. In addition to an unprecedented bull market that led VCs to shell out and destroy billions of dollars in investor assets, venture capitalists also may have made a questionable judgment using an industry process called pattern matching, evaluating startups and founders based on patterns that have been successful before. In SBF, they saw a young man who was quirky in a t-shirt with moppy hair who went to MIT, someone who fits the profile of other founders. So what might the collapse of FTX teach us in the venture capital industry? The attention that is unraveling has placed venture capitalists and raised questions about their due diligence process as they scramble to allocate capital and make them more cautious in identifying flaws before they fund companies. It also underscores the problem with an outdated process, pattern matching, which looks at founders and brings into focus the ability to execute. Far more than their pedigree, Now we turn to another chapter of crypto, a story called influencers. Rochelle, over to you.
All right, thanks, Alexandra. Well, what role did influencers play in pumping up the perception of crypto's returns and its safety as an investment? Well, let's turn now to what responsibility influencers have when it comes to providing this financial advice. Joining us now is YouTuber Carl Runefelt. Carl, thank you for joining me. Obviously, we know that a lot of influencers really under pressure right now when you look under the comments of some of them, when they're looking at what's happening with FTX and the collapse of the FTT tokens, they're wondering who to trust. When they ask you, why should people trust you in this space?
Well, first of all, I can proudly say that I never promoted FTX, and I do very, very big due diligence, and in a way, FTX had a very good brand, so there is a risk that I would have promoted them because they looked really legit, but I never actually did, and I also didn't promote Celsius and these other projects, but many of my industry colleagues actually did. And of course, there is a huge responsibility for people with a voice in crypto to make sure that they only talk about and promote things that are financially solid and are not doing shady business like FTX apparently did. So responsibility is massive.
Carl, you didn't promote FTX, but you did promote Bitcoin. You've been a bull. You called for a $600,000 price target this year. You said it was the best hedge against inflation. Neither's materialized. So what do you say to those who say, well, I trusted what you said, I lost money. Do you take responsibility?
First of all, I never said 600,000 this year, but I do think Bitcoin is going to 600,000, that's for sure. And I take full responsibility for me saying that Bitcoin is the best form of money in the world. Bitcoin can never be bankrupt. Bitcoin can never owe anyone any money. Bitcoin can never scam you. Bitcoin can never hurt you. Bitcoin can only go up and down in price. That's the only thing Bitcoin can really do, aside of all of the fantastic benefits of holding Bitcoin, you become your own bank, your own sovereign. It's a bearer's asset. No one can ever steal your Bitcoin from your hands. It's literally in the blockchain. It's the most secure form of a store of wealth and money in the world. I will stand by that. I will live by that, and I will keep saying that until the day I die. And I also put my money where my mouth is. I buy Bitcoin every day. I accumulate Bitcoin every day. I make Bitcoin as my income, and I don't sell it. I keep it, and my vast majority is Bitcoin. So if anyone loses money in Bitcoin, I'm telling you, I'm losing way more. Right now, of course, the price is low, so there have been better days. I'm telling you, like, I've been richer, but it's just temporary. And all of the fear and uncertainty and doubt that we see now, it's just temporary and can never actually fundamentally hurt Bitcoin itself. Only the price, short term.
But Carl, you can't guarantee that, though. And to that point, then, what do you think is actually going to make it hit the price target that you have for it? What are the factors that you're specifically looking at?
Well, as I said, Bitcoin is the most safe and secure money in the world. And if you look out in the world right now, other forms of money are quite frankly the opposite of safe. You see banks control money, governments have huge influence on money when it comes to interest rates or quantitative easing in general. Like, there are so many factors to money in the world, or what governments call money. I would call it currency or paper. So there's massive security flaws in the current monetary system that we use today. And I think that we're seeing an increasing inflation, as everyone can see. It's not a secret anymore, right? And Bitcoin can never be inflated. So the bigger the problem of inflation becomes, and the bigger the problem of monetary issues that we're seeing, the more valuable Bitcoin should become. That's my prediction, my very, very strong conviction, and I'm betting on it heavily. Like, I put all my money in crypto, and most of it is in Bitcoin.
Carl, you know, the FTX collapse has raised a lot of questions about how closely tied influencer celebrities are to the exchanges that they're actually promoting. To your point, you didn't have a tie-up with FTX, but you do have a tie-up with the Singapore exchange, Bybit, who has said they do, in fact, pay commission to those who promote and then bring in new users. You've launched 2 tokens on that platform now. How much money have you taken from them? And how does that influence your decision?
I haven't taken money from them, but of course, it's not a secret that I'm an affiliate of Bybit, and you have, Bybit, Bitflex, we have Binance. There are multiple exchanges that I have a, incentive to promote. So I'm not hiding that, but I am.
So there's no commission that you take from them, from the users you bring in?
No, that's what I said. There's an affiliate commission, and I'm very, very open with that. It's an affiliate partnership. I have the same with Binance. I never had it with FTX, though. I will be very clear with that. But it's the same with everything out there. There's always going to be partnerships, and it's not a sponsorship; it's a partnership. It's they don't pay me directly. It's a affiliate commission basis, and I'm open with that. So yeah.
All right, we do thank you for joining us today, YouTuber Carl Runfeldt. Thank you so much. Well, some say the reason for a lack of action over crypto regulation is because many lawmakers don't understand what it is and how it works. Maybe some evidence here.
And I don't get the point. I really don't get the point of blockchain and cryptocurrency. It's like keeping track of how many times you chew gum. Like, who cares?
I wonder if you would support changing the name of cryptocurrency to creepy dough currency.
My fear is that we'll view Sam Bankman-Fried as just one big snake in a crypto Garden of Eden. The fact is, crypto is a garden of snakes.
But I have 10 Dogecoin, which a year ago is a doggy coin or Dogecoin? Dogecoin. All right, I have 10 Dogecoins.
Ouch. Well, those were some of our top comments made by members of the United States Senate Committee on Banking, Housing and Urban Affairs from the crypto hearing this week. So, I mean, obviously thought this was interesting, but when we think about this, when we think about the lawmakers trying to wrap their heads around this, and we think about our biggest takeaways, when we think about what's going to happen with regulation at this point, Akiko, what are your biggest takeaways from all of this?
Yeah, well, I can tell you those lawmakers' comments don't instill a lot of confidence for those who say they don't have a full grasp about what's actually happening here. You know, my takeaway is that, sure, we've talked so much about regulation in the U.S., but the question is, this is a global marketplace, and what happens when it's so fragmented? Two examples here, Rochelle. Look at what's been happening in China. They have banned crypto transactions, banned mining, and then you look at somebody like El Salvador, which has adopted it as its legal currency. And now the U.S. trying to figure out where to play in this global regulatory environment. That's going to be an interesting one to watch here, because as we learned with FTX, it doesn't matter where regulation is in the U.S., they were operating offshore, and a lot of American users got caught up there.
And especially when you think of retail investors, I know a lot of the focus is on some of the bigger investors and some of these institutional investors, but for your everyday retail investor, they really got burned. The predominant number of people who actually got into things like Bitcoin when it was already at 40,000, that tended to be actually lower income people. So when you think of who this is really affecting, this is tough. And we're supposed to be bracing for, the crypto winter to continue until at least the first half of next year. And something else to be watching for, the 50-week simple moving average is falling fast, and it looks set to cross the 200-week SMA. That's for the first time on record, signaling that there are going to be even more heavy losses ahead. So retail investors who might be tempted to perhaps buy the dip, jump in there. As we've heard from a lot of the guests today, do your homework. You're going to have to do your due diligence in this sort of environment. Well, that'll do it for now for this week's What Just Happened. A really good breakdown of everything that's been going on in crypto, certainly not going away anytime soon. That does it for myself and Akiko, but we want to also take a quick look at the markets today, because we know that they were still selling off after that Fed announcement. That'll do it for now, but have a great weekend from Akiko and myself. Thanks for watching.